Our base case is for volatility, episodic volatility.
Primary trend is up, but it's going to be delicate. There's going to be some things that are likely broken.
That top 20% of momentum is now starting to just be a little broader.
I worry about a 10 to 20% drawdown this year if inflation does in fact look like it's being sticky or moving up.
I don't know that I look at 2025 and see another 20-odd% return in the equity market.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now as we come into Wednesday following yesterday's losses. Equity futures looking for a little bit of a bounce here on the S&P 500 higher by 0.3%. On the Nasdaq 100 up by 0.4%. Firmly in the driving seat, this screen right here is the US bond market. Check out 10s and have a little look at 30s. We are getting closer and closer to 5% following some surprise economic data yesterday. It was the prices component of the ISM spooking investors just a little bit. Going into more data later, we're going to get the ADP jobs report. You'll get jobless claims as well before the big one on Friday. It's Payrolls Friday.
When you talk about the prices paid component, it came in at the highest level from the ISM services report going back to February of 2023. People looking at this in tandem with the upside beat to the job openings data that jolts the headline figure. Some people saying, look, another sign. What do you need of the fact that there is more momentum in this economy? At the same time, for every positive data point, there was an equal and opposite aspect of that data that you could point to if you wanted to be bearish.
Big question for the nation's capital as we get closer and closer to 5% across the yield curve. Just how much debt can this bond market absorb? A little bit later on today, reportedly, President-elect Donald Trump heading to Capitol Hill.
He's going to be heading to Capitol Hill, sitting down with Republicans now. What is so interesting about this is that debate of whether or not we're going to get one big, beautiful, powerful bill or maybe two less powerful but big bills is still happening right now on Capitol Hill. Wall Street Journal editorial board this morning says, will the real Republican legislative strategy please stand up? And what might matter to this bond market is that clarity. Potentially we'll get some more of that today.
Yeah, how much clarity did you get yesterday in the news conference in Mar-a-Lago from President-elect Donald Trump? Here were the greatest hits. Renaming the Gulf of Mexico, compelling Canada to become the 51st state. There's more. Persuading Denmark to give up Greenland and taking control of the Panama Canal. Quite a news conference yesterday.
It was quite a news conference that threw out a lot of things, but this is what Donald Trump does. He basically takes things where there's a nugget of strategic importance and he puts it in a way that defies the norms of strategic alliances of the past. And basically there is a question here of how much markets have become benumbed to some of the ways that he discusses these things at a time when otherwise, honestly, some people have said Greenland does actually have a strategic benefit to the United States.
It absolutely does. And so does the Panama Canal. What you have to think about when you think about the president-elect Donald Trump is maybe not take everything literally, but take him seriously. And if you take him seriously on what he is talking about, is he clearly wants a level of a sphere of influence back for the United States when it comes to national security and economic security concerns. A lot of people, this unnerved yesterday, but this is going to be what I think he calls a great realignment. This is a man who talks a lot about isolationism, but yesterday there's a lot of imperialistic language.
I feel like we have to say this on repeat. President Joe Biden still the president. Inauguration January 20th. Got quite a year ahead of us, that's for sure. Equity futures right now on the S&P positive by 0.3%. We've talked about the bond market a little bit. In foreign exchange, the euro trading through 103 last week, very briefly with a 102 handle. We're threatening to do the same all over again. Getting closer. We're down 0.2%. Euro dollar 103.18. Joining us this hour, we'll catch up with Russ Koesterich of BlackRock on the latest bond market breakdown. We'll catch up with Adam Posen of the Peterson Institute on Trump's latest threats. And Andrew Hollenhorst of Citi looking ahead to payrolls. We begin this hour with stocks bouncing back following a sell-off fueled by losses in the bond market. Russ Koesterich of BlackRock is cautious, writing, we remain modestly overweight equities but have reduced the magnitude of the position. We expect more volatility as the markets digest uncertainty over the Fed outlook, tariff policy and the headwind from higher long-term yields. Russ joins us now for more. Russ, welcome to the programme, sir. Just how strong is that headwind from this bond market this morning?
Well, good morning, Jonathan. I think it depends on how far you think yields are going to go. 470 on the bond market with a strong economy and decent earnings growth, it's not the end of the world. The equity market can move higher, but obviously people are worried about more of a melt up in rates. That's not our base case scenario, but clearly we're in an environment where both because of the stickiness of inflation, because of concerns about supply, because of concerns about tariffs, it's going to be a bumpier road, and we are going to see the potential for yields to be in a higher range than we had previously.
Russ, how much has changed since 3 weeks ago? And I guess this is a key question as to why are the bond vigilantes coming out now?
I don't think that much has changed. As you pointed out, there was one part of the service component on the ISM that was a bit higher. We know inflation on the service side is sticky. We know that this part of the inflation picture is less susceptible to Fed monetary policy. So I don't think that number told us anything we don't already know. But clearly the bond market is on edge. This is not just about inflation. It's also about supply. So again, I think we have to be prepared for an environment where bond yields are not necessarily quickly reverting to a level that would make the stock market comfortable.
At this point, Russ, you're not particularly optimistic, at least not as optimistic when it comes to stocks as you had been. You're still underweight duration. So what are you actually owning?
Well, we are overweight stocks, and we should be very clear about that. We maintained our overweight throughout last year into this year. We still think stocks can go higher, particularly in the U.S. And the reason for that is, again, if yields are trading, call it very broadly a 4 to 5% range on the 10-year, but you have that in the context of strong nominal GDP. You have an environment where earnings can grow once again in double digits. That's an environment where I do think stocks can go higher. Now, again, you've got to pick your spots. We still think there's room for some of the secular growth companies. We still think consumer companies are very well set up. Financials can go higher. So it's not an environment where I would pull back from the equity market, but I would moderate that overweight.
When it comes to other positioning like gold, you say you have a modest position. Is that something you actually would want to add to? We have seen even central banks this week adding to that gold position, like China.
You're exactly right, Anne-Marie. And I think we would. It's a position that, gold is, you've got to calibrate the right amount. It is an asset class with no cash flow. It can be volatile, but we do see a benefit in the portfolio in this environment. And you think about, what are the risks? Well, clearly, inflation's still a bit of a risk. What Fed policy is going to look like is a bit of a risk. But the other one, which I think has been impacting the long end of the curve, is the fiscal situation. These large deficits that don't appear to go away anytime soon. In that environment, the question becomes, what can you own that governments can't print more of? Gold is a scarce asset, and is that scarcity, coupled with the fact that a number of central banks, including in China, have been adding to their positions, that I think makes it attractive in small amounts in a portfolio over the longer term.
When you think about the fiscal outlook, does it matter to you, or do you think it matters to the bond market that everyone is starting to think has now a potential vote, whether or not there's one big bill, a reconciliation bill with a ton of spending that goes across tax cuts to immigration? Or do you think it'd be better to see this slow drip feed of the potential fiscal spending?
I'm not sure there is a huge preference in the market about how this gets done. Obviously, the longer the fiscal is unresolved, the more uncertainty, the more potential for volatility. But I think the bigger issue for the bond market really comes down to supply. Whether you do this in one bill or two, are you going to add substantially to the deficit? Or are you going to add substantially to supply? Because, again, it's worth going back and remembering what's been happening in the bond market. This has been a fairly substantial curve steepening. And part of that is really about the question of supply, how much the bond market can absorb. And that's where I think investors are really going to be paying attention. What is the net add to the deficit over the long term?
Russ, I think it's a bigger question. When you say things like how much can the bond market absorb, I think which bond market? The US bond market, the global bond market, the UK bond market. I was really interested to see how the price action played out yesterday. If you looked at the economic data come out, we got the ISM, and then you saw the bond yield move. But we saw bigger moves elsewhere in places like the UK, and gilt yields are up again today. And I just wonder, from your perspective, how much crowding out you're expecting, how much pressure we could see on markets elsewhere.
Well, I think that's a totally fair question. As you point out, again, the long end of the UK bond market, also a very big move. And part of what's going on here is, one, there's the crowding out effect, but there's also the reality that this is not just a U.S. phenomenon. In some ways, the U.S. has seen more fiscal deterioration than a number of other countries. But in general, we've seen overall developed market debt rising. And clearly, we're not the only country that has a spending and a debt problem in the long term.
So, Russ, how do you think that plays out in foreign exchange with all of that in mind?
So, it's funny. We still have a little bit of a long dollar bias. I think there's a lot of question about the dollar over the long term, and that's reasonable. But if you think about where we're at, where we're once again in a situation where it's unclear how fast or how much the Fed's going to cut, and you have a strong U.S. economy, and you have the potential for more stimulus, I do think that in the near term, the dollar can hold in, and particularly against some of the other currencies where you're not seeing the same type of growth that you are in the United States.
Russ, before we let you go, you were talking about how you're underweight duration, you're still overweight stocks. That does seem like the better bet. If yields continue to rise, at what point does that switch? Do you go overweight duration and underweight equity risk, considering just the valuation proposition?
I think that's fair. I don't know if there's a magic number. I know everyone is very focused on 5%, and that number is going to keep coming up. It's a nice round number. I don't think you completely shift your allocation. Clearly, if you see a further backup in rates, I do think you get to a point where it starts to become more attractive. But what I would say is that the near-term overweight to equities is really grounded in the environment, in the regime we're in. And that is an environment where, while valuations are not cheap, in the near term, you have a world where earnings growth is likely to hold up. You're still seeing a lot of innovation by U.S. companies. And I do think that still leans towards an overweight to equities as long as yields don't melt up too much.
Hey, Russ, good to hear from you. Thank you, sir. Russ Koesterich there of BlackRock. Should you wait for yields to get to 5 before you buy? Steve Whiting of Citi saying 5 would be something that we would think would be really appealing. This came from Evan Brown of UBS. US Treasuries are now attractive. Expectations on growth and inflation are no longer clearly skewed to the upside. More on the bond market a little bit later. Equity futures right now on the S&P firmer by about 1/3 of 1%, with an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. A fast-moving wildfire has ripped through an affluent area of Los Angeles, destroying homes and forcing thousands of people to evacuate. About 30,000 people were ordered to leave their homes after a brush fire erupted in the Pacific Palisades community, causing panic and traffic gridlock. The blaze has spread to almost 3,000 acres and remains uncontained. The Biden administration is shifting more than $100 million in military aid from Israel and Egypt to Lebanon as it tries to bolster the ceasefire agreement with Hezbollah. The Associated Press reported that most of the money will go to the Lebanese armed forces to help them deploy in the south of the country and supplement the UN peacekeeping mission. Tencent has repurchased 3.93 million Hong Kong-listed shares on Tuesday. That's its biggest buyback in nearly 2 decades, following a Monday sell-off, which was sparked by the tech firm's addition to a U.S. blacklist for alleged links to Chinese military. Tencent has denied the allegations and said it will work with the Department of Defense to address any misunderstanding. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, Trump's big plans.
We're going to be changing the name of the Gulf of Mexico to the Gulf of America. We need Greenland for national security purposes. Canada and the United States, that would really be something. You get rid of that artificially drawn line, and it would also be much better for national security.
That was quite a news conference from New York City. That's next. Good morning. Live from New York City, looking to bounce back from yesterday's losses. We're positive by 0.3% on the S&P 500. In the bond market, little changed. A bond yield near 470, 468, 71. Under surveillance this morning, Trump's big plans.
We're going to be changing the name of the Gulf of Mexico to the Gulf of America. We need Greenland for national security purposes. People really don't even know if Denmark has any legal right to it. But if they do, they should give it up.
Can you assure the world that as you try to get control of these areas, you are not going to use military or economic coercion?
No, I can't assure you. Canada and the United States, that would really be something. You get rid of that artificially drawn line, and it would also be much better for national security.
So here's the latest, and I'm not sure where to start and where to finish. President-elect Donald Trump taking aim at Panama. at Greenland and Canada in a wide-ranging news conference from Mar-a-Lago. Trump threatening more tariffs and refusing to rule out using military power to expand U.S. influence. Bloomberg's Tyler Kendall joins us now from the nation's capital. Tyler, what was the reaction to that news conference?
Yeah, good morning, John. So President-elect Trump used that news conference to try to shape what would be expansionist policy and frame it as potentially good for U.S. domestic policy. We repeatedly heard him hit on three themes there: national security, economic security, but also a competition with China. Look at just Greenland, for example. We know that it is strategically located in the Arctic for U.S. and NATO allies when it comes to countering Russia amid the war in Ukraine. But it's also home to the third largest oil reserves in the Arctic and is also considered to be rich in critical earth minerals, something, as you know, the U.S. has been trying to shore up in its competition with China, particularly as we try to boost our own domestic supply chains when it comes to semiconductors. Now, something in common in all of these places is that leaders of these foreign lands have said that they are absolutely not for sale and have publicly criticized these plans from Trump. In terms of where we go from here, Trump, of course, has been ratcheting up his tariff threats, but it's unclear exactly what those would look like, particularly in these places. You heard him there threaten potential military action when it comes to Greenland and the Panama Canal. In terms of that, he would likely need some sort of buy-in when it comes to Congress.
Tyler, appreciate the update. We'll catch up with you soon. Tyler Kendall there, down in Washington, D.C. The geostrategic importance of Greenland, I don't think that conversation is going away anytime soon. Making Canada the 51st state feels like a little bit of a stretch.
That one feels like a stretch, but there might be economic coercion in the sense that he is serious when it comes to tariffs, when it comes to someplace like Canada. I will just say on Greenland, I covered Russia for a number of years. The Arctic is so important to Russia. I couldn't go through a single conversation talking about shipping, talking about oil and gas, critical materials, without a Russian official bringing up how important the Arctic was to them.
The incoming president well aware of that fact, that's for sure. Let's attempt to continue this conversation with Adam Posen of the Peterson Institute for International Economics. Adam, welcome to the programme. There is a chairman, Chair Powell, who's got to set policy for upcoming policy changes from the incoming administration. Adam, you've warned multiple times that there is a real risk of re-accelerating inflation and perhaps even a Federal Reserve that has to hike interest rates. What did you make of the news conference with Chairman Powell to close out 24, and what would you expect to see in early 25?
Thanks for having me back on surveillance, John. I think the horrifying aspect of the U.S. threatening, even in the vaguest terms, military action against peaceful democracies to grab land is beyond offensive and irresponsible. And we can't sane wash it. There's just no excuse for the U.S. doing that. The prosperity and peace of the world for 80 years has come from the U.S. saying, no, you can't adjust borders through military action. Anyway, on the Fed, if we assume that that was bluster, the inflation risk is there, and it's not just because of the likely Trump policies, although it's primarily going to come from the tax cuts that are online with whatever additions are made that are just going to extend at a minimum the previous tax cuts under the Trump and the Republican Congress, which will at a minimum raise the deficit by around 1.5% of GDP a year going forward. Tariffs are inflationary unless you do them so big that they cause a recession. Declining migration, deportations are inflationary unless you do them so big, unless you cause a recession. So again, even if we assume the moderate middle version of the Trump administration proposals, it's an inflationary situation. And yeah, Powell and the Fed should have seen this coming. They, as I said before Jackson Hole last summer, when I saw some of you out there, they should have said, you know, loose fiscal, bad trade, bad migration is inflationary. And also they should have recognized that they got it wrong on the labor markets in the U.S. They were much more resilient than they thought. That was already clear by last summer. It was already clear by last summer that they had not tightened financial conditions anywhere near as much as they thought. So there's a bunch of reasons I expect the Fed to be announcing in March, April that the bias is neutral to tightening, and I expect them to be tightening once the budget goes through by summer.
So, Adam, are you basically seeing a Fed that can hike after we get these the proposals that Trump is talking about be put down in legislation?
I think, Anne-Marie, that is what's going to happen. And I think it's very interesting. And as expected, frankly, that they were able to push the vice chair of supervision, the step down as vice chair of supervision, but not get Michael Barr to leave the role of a Fed governor, which is entirely legal and right. And it's good he still wants to serve. And that means you've got a very independent board of governors. You've got an inherently independent Federal Reserve Bank president. So even though I think the Fed got it wrong, I don't think they're fundamentally wrong-headed. They're going to face this. What is going to happen, and is already happening, is they're going to be behind the curve, because for political reasons at this point, since they didn't get ahead when it was both Harris and Trump talking inflationary policies, the Harrises were less. Since they didn't get ahead of it, they're going to be slow to react, and that's going to lead to more inflation momentum. Is it going to be impossible for them to get it down? No, but it's going to require hikes starting in the second half of next year.
Adam, what is your base case, especially based off the conversations you're having? Trump came out and said that to get his one big, beautiful, powerful bill through, he's going to have to use those tariffs to offset when it comes to adding to deficit concerns. At the same time, the Washington Post had a report that talked about more critical, narrow, targeted tariffs. Yeah. Do you have a working assumption at this point?
I think it's roughly 60% likely that they will stick with the negotiable tariffs and make claims about the revenue, but give up having reliable tax revenue that can be used in the congressional scoring. I think there is a combination of too much desire from the president-elect, from the Commerce Department, USTR, and even state to do these kinds of leaning on, is it Denmark, is it Panama, is it Canada, as well as Mexico and China, and a little bit too much rationality from the economists in the administration that if you do across the board tariffs, you get revenues, but you also get inflation. I still think, though, that I'm worried, say there's a 25% chance, which is worth worrying about, that they're going to push for what they tried to push for 8 years ago, which is a DIDCUFT, destination-based cash flow tax, which is essentially a VAT, a sales tax, but with added bias against imports and pro-exports. And if they do that, then they can put 10% across the board tariff and say they're replacing corporate taxes with that. And then you do get not enough to cover the loss of corporate taxes, but you get 1.5% of GDP a year on a 10% across the board tax order of magnitude. And they can use that in negotiations. So I think there's a chance, Kevin Hassett's a big advocate of the DBCFT. I think there's a chance they'll try to do that and buy Trump off that way. But my base case is that they can't risk the inflation. They don't want to give up on the bilateral bullying for so-called national security reasons. And so they stick with the really tough on on China and Mexico, go after a couple industries like pharmaceuticals and autos, and then spotty tariffs beyond that.
They might go hard on Canada as well, actually, Adam. We have no idea. But I do wonder going forward, one of the big discussions right now is where we are, not just what will happen under some of these new administration's policies. Do you have a sense of where neutral is right now and how much higher or lower it is than what some people are assuming, including the Fed?
Lisa, again, I'm sorry to keep harping on this, but this has been a discussion that's been out there for a couple of years. I hosted an event at Peterson where we had Larry Summers and Olivier Blanchard 2 years ago talking about the rise in our star, and I've been arguing for over a year and a half. Our star is probably 100 to 150 basis points higher than what the Fed's been treating it as. This is because we've got ongoing fiscal deficits that have risen in the midst of full employment. This is because we've got a good increase, productivity growth trend. This is because we have financial markets now that transmit monetary policy much less dependably. This is because risk has come back in the economy in terms of tolerance versus COVID. And this is because you're getting less inflow of savings from around the world, particularly from China and non-China Asia into the U.S.
And you've warned about it for a while, repeatedly, Adam, and credit to you. Adam Posen there at the Peterson Institute. From New York City this morning, good morning. A volatile start to 2025. Equity futures right now on the S&P 500 positive by 0.3%. 0.1%, looking to bounce back from yesterday's losses. The Nasdaq 100 up by 0.1. This coming from Barclays. Resilient earnings and growth-focused central banks remain broadly in place for equities to climb the wall of worry. The wall of worry getting a few bricks in the last 24 hours. Let's turn to the bond market. One of those bricks coming from the ISM services data in America yesterday. Sounds a little bit niche, but ultimately it's about the prices paid component of the ISM. Surprise to the upside. And I think really spooking this bond market as well in yesterday's session, Lisa. Yields up again this morning, approaching 470 on 10s.
Yeah, and it came with a higher than expected ISM services headline number. So the idea of both more robust activity and an inflationary impulse underneath it really spooking people. At the same time, the employment component, if you want to get really niche, of the ISM services figure actually declined from the November read. You can look under the hood and still find what you want to find. At the same time, the headline data keeps coming in just hotter than people really want to see.
We said this on this program about 25 minutes ago. Don't just look at the US bond market. Look at what is happening elsewhere. In the United Kingdom, the 10-year yield higher by something like 9 basis points on the session, the highest since October 2008. When we start thinking about testing the limits of fiscal space in America, I think we're already doing it elsewhere. You've seen this play out in a pretty vicious way in the United Kingdom.
Well, the United Kingdom is the poster child of it. They're the creator of the Liz Truss moment that is being hung over the heads of all sorts of bond vigilantes around the world, and frankly, government officials that are grappling with a lot of deficit spending. A real question here, and you asked it earlier to Russ Koesterich, how much does higher U.S. yields suck the oxygen out of the room for other countries that don't have the same kind of fiscal dominance that the U.S. and its dollar seem to have?
Bond yields up, dollar stronger. Check this out. Euro dollar, it's a break of 103 again. It's 102.97. We're down on the session by 0.4%. Dollar strength making a comeback on a session this morning with bond yields pushing higher.
And this really goes to the idea that people are pushing back how soon they think the Fed can really cut rates. It has to do with the fact that given the inflationary impulse and some of the better than expected data, now the first rate cut of 2025 could come in July rather than June. That's according to market pricing. And it comes as, where else are you going to go? And that really is what's hanging over this market.
Gold or Bitcoin.
Yeah, exactly.
There aren't that many alternatives outside of the US dollar. Under surveillance this morning, President-elect Donald Trump escalating threats against Canada, against Greenland and Panama, refusing to rule out using military or economic coercion to expand US influence over the countries, including imposing high-level tariffs on Denmark to persuade it to give up Greenland.
So let's talk about Greenland, right? Because I think that's what everyone is focused on. One, the U.S. already has a base there. The U.S. military has a home base in Greenland where we use it to detect missile threats and monitoring space. So there's already a cooperation there. So I have to think, Mr. President, why do you feel the need to take control of it if you pretty much are controlling the military aspects of it? Maybe you want to get some of those more raw materials. Maybe there's a deal to be had. What struck me is the more conciliatory tone we heard from Denmark. You know, back in 2019 when Trump first said this, it was, this is absurd. Now it's, we're very excited that the incoming president has taken a liking to Greenland.
Basically, this really shows how much people understand the rhetoric versus the intent and how to handle Donald Trump. And I think that a lot of this is really highlighting how different it is now than 2016 when people were shocked and clutching their pearls at the idea that a U.S. president would be having this sort of autocratic speech. Now it's okay, it's a negotiating tool. We need to basically have some nice talk and then we can come to some sort of deal. It's a starting point. And that's how it's being treated on the global stage. And I think that that's sort of an interesting departure.
It leads me to wonder whether they're seriously underestimating the extent to which the incoming administration wants a serious realignment across several dimensions worldwide.
President-elect Trump said it yesterday. We want a realignment when it comes to economic security and national security. And that is why he is honing in on these issues. And that is why he continuously comes back to this idea of tariffs and trade, because he thinks the U.S. is not getting a fair shot.
Let's turn to this story from NVIDIA. The CEO, Jensen Huang, telling Bloomberg's Ed Ludlow he hasn't been invited to visit President-elect Donald Trump at Mar-a-Lago just yet, but he's ready to meet him.
I'd be delighted to go see him.
Have you been invited?
Not yet, but I would be delighted to go see him and congratulate him and do everything we can to help this administration succeed.
He's basically the last major tech CEO that hasn't been down to Mar-a-Lago to meet with the president-elect.
Right. When Ed asked that, I was thinking there's no way he hasn't been down yet to Mar-a-Lago, but he hasn't. Maybe one potential word of advice to the the CEO is you just show up, maybe don't wait for an invitation, go there and say, I'd like to speak to the President of the United States. It was the follow-up that Ed asked about tariffs I thought was very interesting. He gave a very diplomatic answer saying, we are happy to work with the administration and give them, quote, as much insight as we can from our perspective. Of course, remember, NVIDIA at this moment is already facing a ton of restriction when it comes to the most advanced, expensive chips when they want to sell them to China.
Which is why I thought it was so interesting that he said that he welcomes that this president seems to want less regulation and that they think the light touch will allow them to move fast because we have to move fast. Those are his words. I just wonder whether that really applies to the tech sector.
Move fast and get back to the office is the message coming from JP Morgan, planning to bring back staff into the office 5 days a week. Sources telling Bloomberg the bank is set to announce the change in coming weeks, replacing an existing 3-day mandate for many of its workers. The move marking a return to pre-pandemic expectations. And I have to say, things that don't usually happen when labour markets are super, super tight.
That, I think, is really the takeaway, which is that a lot of companies are saying get back to work because they can. People can't say, well, I'm just going to leave and go to another company that will allow me to be there because they don't have the same kind of job openings. I will just say about 60% of the staff already do come in 5 days a week. This is everybody else. And the fact that they're not worried about losing them, to me, I think is the right takeaway.
The employer taking back some leverage.
Well, what I found so interesting is why now? In the fall of last year, Jamie Dimon was in Washington, D.C., and he was chastising D.C. federal workers, saying Washington, D.C. needs to get back to work. Goldman, I think, had a full-on office, full-time in office in 2021, and then reiterated and reminded their employees of it in 2023. So why is it taking J.P. Morgan till 2025 when we know the culture at the top, the CEO is, you should all be at your desk?
So let's park J.P. Morgan and let's talk more broadly about corporate culture in America right now. I think the CEO and corporate culture and the space between them is getting wider and wider and wider and has done for much of the last decade.
There's two CEOs.
Human resources.
Exactly.
The head of the HR department in many of these companies have become incredibly powerful over the last several years across the whole host of different topics.
To me, this is the question of how do you maintain corporate culture with a large company, and that's something that's being reassessed. I'm not an HR specialist, but I do think that this is something that's increasingly at issue with the sort of get back to office, but also more than that, what is corporate culture and sort of how do you imbue that throughout the ranks?
Pick a company, any company in America. Listen to an interview with the CEO, an old school CEO who's been around the company for a long time, and listen to them talk about corporate culture. Then go speak to some people who work there and get an understanding for how things are actually functioning and how much human resources have changed the operations over the last few years. And you'll get two very different views of what corporate culture is.
Well, you talk about the size of the company, and the bigger the company, the more that's true.
Yeah.
The smaller the company, the more you can kind of create that. Honestly, it's a bigger discussion about a lot of companies, and I don't think we have time to really wade into it right now.
No doubt we'll have that conversation later this year all over again. Let's turn to big tech. Meta announcing major changes to its platforms, impacting hundreds of millions of US users with a focus on free speech. The company dropping third-party fact-checking and overhauling its content moderation. Stefan Slowinski of BNP Paribas Exane writing, we view the moves as a complex political gamble with potential for near-term payback, but also medium-term risk, which investors need to weigh up. Stefan joins us now for more. Stefan, welcome to the show. I want to start with this. So they're stripping out liberal political influence, and it may well insulate them from the regulatory impulse of the GOP. Do you think they believe this will help user engagement? Do they think it will lead to a rethink on things like TikTok from the incoming administration? How do you think about this shift from Meta?
Yeah, good morning, Jonathan. Thanks for having me on. So I think as investors, we need to look at this through a framework of what will advertisers think, what will users think, and what will governments and regulators think. Obviously, advertisers maybe being the most important as they're what drives the revenues for Meta. And the risk here is advertisers may fear that Meta becomes Twitter 2.0. You know, will we see increased content that is not to the liking of brand safety for those advertisers? You know, Twitter has reportedly seen revenues fall from more than $4 billion in 2022 to just around $3 billion last year. So I guess that's the risk is advertisers worry about brand safety and as investors, you know, that could impact the top line for Meta medium term. As you point out, near term, there potentially could be some upside if this helps decisions around TikTok move in Meta's favor. On the 10th, so on Friday, TikTok is going to be pitching the Supreme Court to put off the ban in the U.S. That's supposed to come into place on the 19th of January. So that's a really near-term event that Meta could stand to benefit from.
Stefan, I'm wondering if you can go back to 2016 when Meta first put into effect that third-party content moderation apparatus that, frankly, they seemed to walk back in yesterday's commentary from Mark Zuckerberg, saying that that was a mistake because those third-party content moderators actually were not completely independent in terms of their thinking. Do we have a sense of how much advertising revenues increased, decreased, how much traffic increased or decreased after that move went into effect?
Well, there are third-party research that do show that a lot of that moderation has been successful in terms of reducing harmful content on the platform. And so when you look at Meta's own business, the success that it's had, the growth it's currently delivering, near 20% advertising revenue growth, it certainly seems to be working, or at least not holding the company back. So that's kind of the unknown here, is as they do start to pull back some of those fact-checking capabilities, will that have an impact on users, maybe certain groups of users not feeling welcome anymore and moving elsewhere? And will that create an opportunity? Ironically, it was Meta through Threads that took advantage of the troubles that Twitter and X were having, where they've built a business now with 300 million users. So we could see some others trying to come in here and take advantage of potentially the changes at Meta to jumpstart their own companies and their own businesses. That said, Meta still has 3.3 billion daily active users globally, so it's still going to be an attractive platform for advertisers to come to.
Stefan, when you zoom out, there was a larger message in yesterday's move by Meta, which was, how much does this signal that if you're in direct competition with an Elon Musk business, you potentially have a target on your back when it comes to regulatory impulses of this administration? And that was one of the speculations of a number of analysts yesterday, that Mark Zuckerberg was trying to get ahead of that. How much do you think that that is a real factor to take into account when having your corporate analyses of different tech companies?
Certainly, Meta is in a trickier position because you're right. They do have businesses that compete with the new president, Donald Trump, and with Elon Musk. And obviously, Mark Zuckerberg personally has had some challenges with Elon Musk and even President Trump with deplatforming it in 2016. So, these steps could be seen as steps to alleviate some of those frictions. But also, I think what we're seeing with big tech companies is a desire to avoid increased regulation, increased scrutiny over the next 4 years. It's like getting a house alarm. The main goal is to get person to move on. And so, Meta's trying to take itself out of the eye of the fire here in the U.S. But ironically, this could ratchet up pressure for them in Europe. Meta is already being investigated for being in breach of the Digital Services Act. There was some aggressive tone from the company yesterday about trying to push back on European regulation around censorship with the help of the U.S. government. We have the upcoming AI Safety Summit in France, in Paris, on February 10th and 11th, and we're starting to see this integration of social media and AI as AI agents and AI assistants like Meta AI, like Grok, like Gemini, like GPT, ChatGPT start to become more prevalent. So these are all important subjects outside of the U.S. And while Meta may have taken some heat off itself inside the U.S., it may be ratcheting up the pressure outside the U.S. Europe's 25% of revenues for Meta, so it matters.
Well, is that really the means to the end? Part of what Mark Zuckerberg maybe is trying to do is make sure that he has the backing of the U.S. government as he deals with this regulatory environment in Europe?
I believe that's part of the messaging from the company yesterday, is working more closely with the U.S. government on some of the pressures that Meta and other U.S. companies are feeling globally. And so that's certainly something Meta seems to be trying to put into place, is more of a partnership with the U.S. government than maybe it's had in the past. But again, these are sensitive times. This is a really hot button subject right now in Europe. We had the Southport riots in the UK over the summer, the UK government imprisoning some people for putting posts on Facebook inciting those riots. Of course, we've got Elon Musk right now courting the far-right party in Germany and hosting them on X. And leaders of these countries, leaders of France, leaders of Germany, leaders of the UK coming out publicly and trying to push back on some of these social media sites. So it's a really hot button subject right now. And, lots being said about the divide between the US and China in terms of technology. That's almost a done deal. But we may be seeing more of a divide coming between the US and Europe as well. The challenge for Europe is you don't have the homegrown companies to be able to replace some of these US platforms. So that's the challenge for Europe, and it always has been.
Hey, Stefan, That challenge is not going away anytime soon. Thank you, sir. Stefan Slowinski there on Meta. Meta this morning down about 0.4% in the pre-market. With an update on stories elsewhere, with your Bloomberg brief, let's cross over to Danny Berger. Hey, Danny.
Hey, John. NVIDIA's Jensen Huang, the CEO at the center of the AI boom, says that he's ready to meet with President-elect Donald Trump and offer his help to the coming administration. Huang spoke with Bloomberg's Ed Ludlow.
I'd be delighted to go see him.
Have you been invited?
Not yet, but I would be delighted to go see him and congratulate him and do everything we can to help this administration succeed.
Donald Trump has said that he will impose trade tariffs that may affect companies like NVIDIA, which rely heavily on overseas sales and outsourced manufacturing. We're going to have much more of that interview with Jensen Huang coming up in a few minutes. Now, Novo Nordisk is expanding a drug development deal with Valo Health to find new obesity and diabetes treatments using AI. The Ozempic makers pledging an additional $1.9 billion to the partnership. The original deal focused on cardiovascular disease and was worth as much as $2.7 billion for 11 programs. President-elect Donald Trump has stated that he would seek to prevent the construction of wind farms during his second term. Once back in the White House, Trump has the authority to approve or reject multi-billion-dollar wind projects planned off the coast of the U.S. on federal land. Trump criticized wind power as expensive and harmful to the environment. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Appreciate it. Up next on the program, the U.S. labor market in focus.
We had a huge boom to refill all the jobs that were emptied out, that were vacated at the worst of the pandemic. It took several years for us to get back to that level. There's a lot of health in the U.S. labor market because the economy itself is very healthy.
Up next on the program, Andrew Hollenhorst of Citi. Equity futures turning negative in the last 15 minutes or so. We're down about 0.08%. This story came from CNN this morning that the incoming president is considering a national economic emergency declaration to allow for a new tariff program. This is something the campaign talked about openly over the last 6 months or so. So I'm surprised by the extent to which markets have responded to it, and I'm questioning what's new about the reporting.
Well, that's exactly my point. I'm not sure why this is news to the financial markets. Potentially what they are picking up on is this seems like the antithesis, though, of the Washington Post story, which felt like maybe there's going to be a more narrow, targeted approach to tariffs. This feels like this is more of an aggressive approach to trade and tariffs.
Clearly very jittery about this story, and we'll stay on top of it for you. Under surveillance this morning, the U.S. labor market in focus.
We had a huge boom to refill all the jobs that were emptied out, that were vacated at the worst of the pandemic. It took several years for us to get back to that level. There's a lot of health in the U.S. labor market because the economy itself is very healthy. We should continue to monitor the unemployment rate for people who've been unemployed for 27 weeks or more. We're seeing that creep up a little.
So here's the latest this morning. Investors looking to cap off a busy week of economic data with U.S. payrolls due on Friday. The median estimate in our survey calling for 163,000 jobs added and unemployment to hold steady. Andrew Hollenhorst of Citi has got a different idea on things. He's looking for 120 and a very different unemployment rate. And Andrew joins us now for more. Andrew, good morning.
Good morning.
Let's start with unemployment. You think that's the bigger issue. What's your call?
I think that's the more important issue. We're calling for 4.4% on the unemployment rate, which is not as big a move as it sounds like. And this is maybe the silliness of what we're doing here. But I have to get into the hundredths of a percentage point on the unemployment rate. We're at 4.24% unrounded right now. So that means if we just move up by a little bit more than a tenth, right, a tenth and a hundredth, then you're up at 4.4.
Why are you not dissuaded from your more bearish outlook on the employment market when you see things like the JOLTS data, the job openings data that come in hotter than expected, with actually the inflationary read-through of ISM coming in at the hottest level since 2023?
Yeah, I think when you look at some of this data, and this is the issue we're all dealing with, economists, the market, the Fed, there's so much noise in the data. And there are different details of the data you can look at and tell different stories. So the JOLTS report is a great example of that. If you look at the level of job openings, that's stabilized at a higher level than where we thought it would have stabilized at. So that looks quite healthy. If you look at what people are doing, which I think are the more relevant statistics in that report, you see layoffs are low, so that's very good news for the job market. But you also see that the hiring rate is quite low, and that actually surprised us to the downside yesterday. That got a lot less attention. It was low in October. October, we know we had the strikes, we had hurricanes. But then in November, it actually continued to move lower. You look at the quit rate. Are people feeling comfortable quitting their jobs? And this is kind of, goes back to what you were talking about with companies bringing workers back 5 days a week, right? People are not feeling as comfortable now that they can find a new job if they leave their job. So those are the kinds of signs of softness that we're seeing in the data that we think are going to continue to feed through and lead to a higher unemployment rate.
Yeah, just talking about the quits rate, that was 1.9%. It was tied with the lowest rate going back to 2020, right. Talking about that dynamism. I just wonder how offsides you think this market is, how much pushback you get, and what you say to people who say, you've been out of consensus for a while, the data's been surprising to the upside, why aren't you capitulating?
Yeah, so I mean, if you look at how much we've moved, it's really been incredible over the last 6 months or the last 3 months. In September, after we had the weak jobs report and the Fed was cutting 50 basis points and the Fed was quite worried about unemployment picking up, then we have had a run of better data since then. We're trying to look at the underlying trends and not kind of change the view every month based on where an individual data point is coming in. And I think, and I don't blame the market because I think, like I was saying, there's been a lot of noise in the data. The Fed is reacting to that noise in the data. So that means we've had 10-year Treasury yields that have been all over the place. We've had 2-year Treasury yields that have been all over the place. I think we're just going through a phase now where we've seen some better numbers. That unemployment rate at 4.24%, it would be 4.6% if not for the participation rate dropping. And I think we'd be in a very different discussion, right? We'd be having a different discussion right now if we were at 4.6%. So it just shows how quickly the narrative can change.
Will you maybe change your mind January 20th? Is the president-elect's immigration policies that he's talking about going to mean a tighter labor market?
So this is part of the issue with trying to do a forecast here is that these policies do matter quite a bit. That's why the market is moving so much on each of these headlines and will continue to move. And it's not necessarily January 20th when everything is going to be answered because, yes, we probably should get some answers on immigration. I'm really interested to know what does this reconciliation package look like? What's in this fiscal bill? If it's just extending existing tax cuts, that's not a big new fiscal stimulus to the economy. That's just extending what's already there. If we're getting no tax on overtime pay and these other kinds of things that could push the deficit higher, then that is more stimulus. That would change the Fed's view. That would change my view. Let's see what happens.
Just quickly, in about 15 seconds, if you can, if we get 4.4% this Friday, 120, is that sufficient to cut rates at the end of this month?
I think they may still pause even in that event. I think they have to see something in addition to that. It probably sets them up to continue cutting later this year, but they've really signaled towards this pause in January.
Mike Schumacher of Wells Fargo saying that if we get that 4.4% that Andrew and the team are looking for, it would be ugly and we'd see the 10-year yield falling 20 basis points in that scenario. We've had a big move in the other direction over the past few months. Andrew, it's good to see you, sir. Thank you. Andrew Hollenhorst there of Citi. Up next on the programme, Mike Wilson of Morgan Stanley. Rob Casey of Signum, Global Advisors, will catch up with the New York Congressman Mike Lawler and Padhraic Garvey of ING with some big moves in this bond market in the last 24 hours. Not just stateside, but worldwide. From New York, this is Bloomberg.
We're going to that point where rates are the things that pressure equities.
Markets are pricing that rates will stay higher for longer, and therefore we will not get all these cuts.
Fed communications is always difficult. It's difficult for any institution that is dealing with uncertainty.
You're seeing that term premium, that uncertainty factor really start to rise at a more rapid pace.
We're preparing ourselves for another year of a lot of uncertainty and a lot of volatility in yields as we go in through this year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now with some big moves in the bond market. Let's start with equities. Equity futures just about unchanged on the S&P 500. On the Nasdaq, a similar move. Some headlines in the bond market in the last 24 hours. The 30-year yield testing levels we haven't seen going all the way back several years. In the UK, you've got to go back several decades. 2008 for the last time we saw a UK gilt yield as high as it is right now. Across the curve stateside, we're pushing levels we haven't seen in more than a year. We've got a 10-year getting closer and closer to 5%, Bramo, 469.94. And I think the point we're making this morning, it's not just an American move. It's American-led. But we're certainly seeing big moves elsewhere.
And this comes with this resurgence of inflation, the stickiness of inflation that we're seeing around the world. But it's also coming with supply anxiety. And I think we have to keep harping on this because it's in the U.S. where the deficit is deepening. But the U.K., you talk about some of the highest yields we've seen since 1998. The U.K. 10-year yield hitting the highest rate since 2008 just this morning. A question here about how much we have suddenly sucked the oxygen out of the room with U.S. yields being where they are for other countries to also finance deficits at a time of technological transformation and legacy programs that need to be financed.
It's a point we've made repeatedly throughout this morning. The crowding out of other countries. They're losing fiscal space. And maybe the American data, upcoming US policies are going to make that even more difficult. Trade policy in focus as well. A report from CNN out in the last 30 minutes or so that the incoming president is considering a national economic emergency declaration to allow for new tariffs. Now, I have to put this out there. This is something we've heard from the incoming administration several times. Using so-called IEEPA is not new.
And he threatened to use it as well in his first iteration as President of the United States in Trump 1.0. There's a story out this morning from Jenny Leonard, who is a fantastic trade reporter, and she talks about Trump has always played his unpredictability as key to his leverage. And that is almost probably what you see in a lot of these stories. Who was leaking to the Washington Post? Who was leaking to CNN? You can see the rival factions within the incoming administration on this key point because there's different ideologies surrounding the president on how they think tariffs should be used.
The takeaway should be everything is on the table.
Exactly.
Big time. What we've got this morning in the FX market is euro dollar breaking 103 again, 102.97. We're negative by 0.4%. Dollar strength is making a comeback off the back of these moves in the bond market, off the back of the pushback we've seen to the Washington Post story early this week about a potential of watering down tariffs of the incoming administration.
Basically, all roads right now, whether it's economic data that's been surprising to the upside with JOLTS and ISM services yesterday, or whether it's the idea of tariffs that could potentially hurt the rest of the world more than the United States, it's all leading investors to push back their expectations for the Fed to cut rates until later this year, reducing the space for them to do that and increasing inflationary pressures. And that's the reason why the dollar seems to be ongoing the haven for a lot of people.
The ISM services print yesterday really got this conversation moving in a bigger way this week. We've got more data this morning. ADP at 8:15 Eastern time. Jobless claims brought forward a day because of the late President Jimmy Carter's funeral tomorrow. We get jobless claims at 8:30 this morning. Then it's on to payrolls this coming Friday. Coming up this hour, we'll catch up with Mike Wilson of Morgan Stanley on the breakout in bond yields, Rob Casey of Signum Global Advisors as the incoming president heads to D.C. And we'll speak to the Congressman Mike Lawler as GOP lawmakers look to extend and defend Trump's tax cuts. We begin this hour with stock steady. Investors taking stock of an equity and bond market sell-off in the last 24 hours. Mike Wilson of Morgan Stanley saying equities are rate sensitive once again, which is another reason to stick with quality. Rates are the most important variable to watch in early 25. Mike joins us now for more. Mike Wilson, good morning. Happy New Year.
Good morning, John.
It's good to see you, sir. Let's start with the bond market and the importance of it. What is driving these yields higher, and how important is the why to the equity market?
Yeah, that's the right question. It's not just rates are going up, but why are they going up? I think Lisa mentioned a few things that are driving it in our view, which is some of the fiscal sustainability questions. We have a new administration, and while it is the second version of Trump, it's still uncertain, right? It's a new administration. There's a lot of new cabinet members. We just don't know. And usually the first quarter after a new president and new administration comes in, the markets typically don't do that well, right? We rally into the election, have a relief, and then we have these variables that we don't know. So the main risk that we talked about a month ago was probably U.S. dollar strength and rates. And that was always our view going into the election, that Trump would be good for stocks and probably not as good for bonds. And that's exactly what's playing out. So we had this euphoria around the election. We're getting a pullback on that. There's two things that are driving rates now. I think it's more about inflation and fiscal sustainability than it is about growth. And that's the key. And that's why the rate sensitivity now matters for equity multiples. We track this closely, right? The correlation between multiples and rates flipped negative again when we crossed over 4.5%. Almost exactly what we thought, because that's what we experienced last year in April. So it makes perfect sense. So this is the issue. We don't know how it's going to resolve itself, but until this does resolve itself in a favorable way, meaning rates go back below 4.5% and term premium comes down, right? That's the other part of the variable. So term premium's up 77, 80 basis points, somewhere in that range. That's a massive move, I mean, in a very short period of time. So I'm actually surprised that multiples haven't come down more, okay? Now, part of that is because the high quality stocks are where people are crowding into still, not only in the US, but globally. And that's probably keeping the S&P multiple a little higher than it would be normally. But if this persists, multiples are going to come in more.
That mix is toxic for risk appetite, the way you've laid out things. We had Torsten Slok in your seat yesterday from Apollo, who raised the risk of a repeat of 2022. Would you share that fear? A year in which stocks and bonds do poorly?
Yeah, I think that's fair. I don't think it's going to be nearly as severe. I mean, the Fed's not raising rates. I mean, in 2022, I mean, they raised rates 400 basis points, and that's not happening. So I think that's a little extreme to say that, you know, bonds are not going to sell off that much. Okay, that's point number one. Point number two, though, is that multiples are much higher coming into this year than they were, say, in 2022 relative to where bond yields are. So in other words, I've been surprised, I think a lot of people have been surprised that multiples have gotten this high in the face of rates at 4.5%, 5%. I mean, that's where we've been for the last year. That's probably been the single biggest miss by most people that multiples could be this high. So you have more give, I think, in multiples to come down, even if rates just stay in this range. Like, they don't have to go up 100 basis points for multiples to come in 10%. And that's what we're trying to figure out. So what do you do in that environment? Well, you still stay up the quality curve, okay? That's typically what works. And if you look at what happened, by the way, in the fall, the low quality stocks absolutely went bonkers. So that has to come out of the market. That's where we would be most concerned, or most kind of area we'd be most avoiding for the next sort of 3 to 6 months.
What's interesting to me is how much the narrative has shifted around which area of the equity market is most rate sensitive. At one time, it was considered the high-flying tech stocks that would be really hit hard. Now you're talking about actually some of the rest of the index that you think are going to have to come in. Is that how you'd frame it, that essentially tech stocks are not nearly as rate sensitive as a lot of people used to think they were?
Well, let's be clear. Not all tech stocks are created equal. Okay, so like you got to separate, you know, the 10 magical stocks, whatever you want to call them, versus everybody else. If you look at the average tech stock, right? You look at the equal weighted tech index. It's been lousy, right? It hasn't performed that well relative to the overall market. It looks like the average stock. So once again, you know, we're talking about monopolies here. Okay, monopoly businesses, high quality businesses, and it's not just tech stocks, right? There's about 30, 40, 50 types of these businesses. They will typically hold up until growth becomes a serious problem. Like, that's not where we are right now. We're not in a recession. We're not in a situation where growth is going to really disappoint like it did in 2022. That was the big difference, I think, in 22 versus today, is that 22, we had a massive earnings recession. Okay, I mean, and led by the Magnificent Seven, by the way. That's not what we're forecasting right now. So that's what probably keeps a bid into some of the higher quality parts of the market. Now, having said that, if we go through 5% and term premium continues to go, yeah, the exposure in the equity market is in that space, and those stocks will eventually get clipped the hardest. But we're not quite at that threshold yet.
John was mentioning Torsten Slok. A number of other guests yesterday were talking about how important it is to have an increasing allocation to cash at a time when there is going to be a lot of volatility and there is great uncertainty about rate sensitivity as well as fiscal policy in Washington, D.C. Do you agree with that?
Cash is great right now. I mean, you're getting a really good real return. You have no duration risk. Like, what's wrong with cash? Doesn't mean you have 40% cash, but like, we're still very much short duration, right? So when I say cash, it's like 2 years and in. I mean, that's like cash management. By the way, that's what most clients have been doing. You know, having a barbell of kind of your equity portfolio, your risk assets, and then within your fixed income portfolio, they've basically shortened their duration. So that's essentially how people are positioned: cash heavy, and then maybe taking a little more risk in their equity portfolio. That barbell's worked quite well, and I don't see why that's going to change.
You said one thing that's different now than in 2022 was the Fed was raising rates. We just had Adam Posen on, who thinks that the Fed's going to be forced to raise rates this year, though, because of what's going on, the policies in Washington, D.C. and sticky inflation. Do you think there's no chance that the Fed raises rates this year? No,
of course there's a chance. I mean, it's not our house call. But if things continue to move in this direction, and let's say we get an oil risk, to the upside. Oil's kind of making a move right now. I mean, that could cause the Fed to raise rates 25 basis points. But even if we say that, okay, we're not raising 400 basis points. That I'm very comfortable saying the chance of that is zero. Okay, right. So that's how I think it's different than 2022 in that sense. I don't think there's as much downside for rates, but that doesn't mean there couldn't be 10% downside for many stocks, just if rates stay at this level.
It's only the second week of 2025, and already we've had multiple narratives on fiscal expansion, on tariffs. What's one thing you would love to have clarity on to understand the market this year?
Well, I think clearly tariffs is going to be the one that is the most, that's for equity investors, that's going to be the biggest focus because that can affect earnings probably the most severely in growth. All right, immigration I think is going to be kind of a push and take, and I think the other one is taxes. Are they going to try to get more tax cuts through, or are they just going to try to extend the existing tax cuts or the current tax law? And that will affect, I think that will affect rates. So it's really tariffs and taxes. I don't think we're going to know about taxes for quite a while. I think tariffs we're going to know quite a bit in the next month or two. And we've said this for a while. We said we think the first half is going to be choppy. Okay, second half, if they can execute on all these policies and we can kind of get to a point where the markets get comfortable with this, the second half of the year could be much better for equities.
What do you like? Where are the opportunities? I mean, there's hiding out in quality stocks, but is there anything that's getting you actually excited?
Well, I think the area we've been most bullish on is financials. I do think that's an area where it seems to be a lot of a coalition around deregulation. There is pent-up demand for M&A. There's pent-up demand for other capital markets activities. So I do think financials is an area we continue to think there's value there. And that's a global call. The second one is probably energy and commodities and materials. These parts of the market that, like, we can't do all these things everybody wants to do, like build data centers, add infrastructure, robotics and all these things. You need materials, you need energy for that. So I think those are areas that have been overlooked by the market, underappreciated by the market, that could be quite interesting this year.
Mike, good to see you. Enjoyed the note to start the week as well. Right. Mike Wilson there of Morgan Stanley, thank you. Yields pushing higher on a 10-year, up by another 2 basis points, 3.470. The spread between the 2-year and the 10-year, 341 basis points now. So that's a steeper U.S. yield curve.
And it's the steepest going back to 2022. It raises the question, is that a positive thing? Is that a normalization? It'll definitely help the financials. Or is this a negative thing, portending the idea of stickier inflation and a higher term premium that could be punitive?
I think Mike said it well, put it perfectly. The why is really important here, and the why is not good. It's not great. It's about prices paid on an ISM. It's about a fiscal trajectory of the United States. All of those things adding up are not good for risk appetite.
You raised this point, though, and I think it's a really important test that comes on Friday. How much this market has baked in a higher inflation rate that could be absolutely torpedoed if we get an employment report that underwhelms, that comes in light, how much we could see a rally. And I think that's going to be an important test. If we see that, what that does to the entire narrative.
Shall I tell you who needs a downside surprise on Friday? The UK gilt market.
Yes,
without a doubt. If I'm in the UK right now at Treasury, I'm sitting there like this, a Friday, 8:30, saying, please, downside surprise, because this gilt market's running away now. Yields are up on a 10-year UK government bond by 10 basis points on the session. We're pushing higher and higher.
Yeah, it's the highest levels in that denomination going back to 2008 at a time where you have growth that just isn't performing. And that's something else Mike Wilson said. This is on inflation and this is on fiscal. Globally, this is not on growth, and that is a toxic mix for a lot of countries.
Bond yields up across the curve. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. It's Danny Berger. Hey, Danny.
Hey, John. Los Angeles is ramping up evacuations as the Palisades fire grows in size. The uncontrolled fire is threatening densely populated Santa Monica, California. Widespread and damaging wind gusts are expected to worsen, hampering efforts to contain the fire. The fire was at almost 3,000 acres, and 2 other blazes flared up overnight. Exxon predicting lower oil prices that will hit their production division by about $700 million in the fourth quarter. Refining and chemical margins also shrank in the final months of 2024, but were partially offset by higher U.S. nat gas prices. Exxon's guidance is a sign that the fourth quarter was a tough one for big oil. And CNN reporting the last hour that President-elect Trump is considering declaring a national economic emergency to provide the legal grounds for universal tariffs. 4 sources familiar told CNN that no final decision has been made, but that Trump is fond of the measure since it would give him wide-ranging jurisdiction on how to implement tariffs. And that's your brief, John.
Danny, thank you. Appreciate it. Up next on the program, Trump heading back to Washington.
I like one big, beautiful bill, and I always have, I always will. But if 2 is more certain, it does go a little bit quicker. I can live either way. I like the idea of the one big bill, but I can live either way.
A conversation up next, live from New York City this morning. Good morning. Check out stocks and check out bonds. Bond yields pushing higher once again with 3.470 on 10s. Your 10-year this morning up 3 basis points, 471.57. That's taking down equities and pushing up the US dollar. Equities down 0.2%. Euro dollar breaking through 103 again, 102.91. We're negative by 0.5. Under surveillance this morning, Trump is heading back to Washington.
I like one big, beautiful bill, and I always have, I always will. But if two is more certain, it does go a little bit quicker because you can do the immigration stuff early. We have a leader that I have a lot of confidence in. I think he's going to be, hopefully, a great leader, a great speaker. I can live either way. I like the idea of the one big bill, but I can live either way. But they'll be coming down. The senators also will be coming down, and then ultimately we'll be meeting in the White House in a few weeks.
So here's the latest this morning. Trump reportedly heading to Capitol Hill later on today to discuss his agenda with Senate Republicans. The president-elect signaling he would accept 2 separate packages to push his agenda through. Rob Casey of Signum advises saying the most likely path forward for the now-seated Republican Congress is one massive, all-encompassing reconciliation package. The most significant issue for Republicans is timing. Speaker Johnson's goal of April is ambitious. Rob joins us now for more. Rob, good morning. It's good to see you. I've got to start with this one. Canada becoming the 51st state, renaming the Gulf of Mexico, whole range of issues including Greenland and Panama. When a client called you yesterday and said, Rob, I missed the news conference, what happened? What on earth did you tell him?
Well, you have to see through a lot of that noise, right? Canada won't be the 51st state. Greenland certainly won't be the 52nd state. Both countries have already come out and said that pretty clearly, as if they had to. But intermixed in there, we're talking about 5% of contribution to NATO. We're talking about all energy, the border, all these things that really are policy priorities. So, you have to ignore the Canada and the Greenlands of the news conference, seemingly every news conference, and focus on what matters. And it's in there. You just have to look.
And Panama Canal. So what is he getting at?
Well, I think he's getting at a few things. First of all, there are geopolitical, trade flashpoints and choke points that the U.S. has to ensure remain open, right? Not only over the course of the next 4 years, but into the future, generally speaking. The Panama Canal is one of those. Greenland is a vital military base for the U.S. We have a military base in the northeast of the island that really does a lot for our missile defense system. So there are all of these, right, necessities. The U.S. does not control these places. The U.S. won't control these places, but we need to have access to these places. And so in the more broad geopolitical competition, I think offense is the best defense. So Trump is going to talk about wanting to expand these presences rather than eliminate them.
Drilling down to potentially the substance the president-elect was trying to get to is that he cares a lot about national security and economic security. And while maybe he's an isolationist, he's using this imperialistic language because he cares about those two objectives. So if that's the case, how do you think he's going to implement some of his trade policy like tariffs? Because just in this week alone, we've seen two different potential paths.
Yeah, so I would put the tariff conversation in 2 buckets. The first is very ideological and punitive. I would put Europe on the top of that list. We think tariffs on Europe are probably going to come earliest, maybe not on day one, but certainly before April. And I would also put sort of part of the China tariffs on that in that punitive bucket or really ideological bucket, focused on decoupling from key sectors. I would honestly say the rest, especially Mexico and Canada, has to do with, wanting to get the best deal, wanting to incentivize, eliminating drugs and migrants crossing the border. If I'm Europe on tariffs, I'm really worried. On China, I think there's some daylight for agreement, but I think, in the second half of the Trump term, we certainly will see efforts at decoupling. Everyone else, I think, it's part of the conversation.
So back to John's original point, when he was leading in your note about this negotiation on one big bill or 2 potential bills, Trump's talking about the fact that tariffs are going to be the main means to pay for it. So does he need to have a lighter touch on tariffs until those bills are decided?
Well, I think one thing that we don't know this for sure, but I can almost guarantee that we will not see tariffs passed as part of that reconciliation process. Now, maybe that sounds like going out on a limb, but from the conversations that we have in Washington, D.C., Congress members do not want to vote on tariffs, right? Because they don't want to be on the hook when tariffs prove to be inflationary, when tariffs, cause significant retaliation from Europe and particularly from China, which hurts farm and ag states most frequently. So members of Congress really don't want to legislate tariffs. Trump is going to have to do it via executive order. He can and will do it via executive order. And to a certain extent, maybe these tariffs do pay for the broader Republican agenda, but they won't be part of the same package.
On a related note, if someone had called me, as John had put it, and asked, I said I hadn't really seen the press conference. What did I miss? I would have said, the most important thing that you missed was that Donald Trump said interest rates are far too high. And that's very concerning. And I know you would say very in character.
Bit of home bias.
Well, it is a bit of home bias. But when you cut through the noise.
Not sure the Danish quite feel the same way.
Well, okay, the Danish can worry about Greenland, but I'm worried about whether this is something that Donald Trump can pay for and whether he cares about what the bond market is saying and what the signal is from term premium that are climbing to the highest levels that we've seen in a long time. How much of a signal is that? How much is that something that you need to pay attention to outside of some of what you call the noise?
Well, I mean, I think it could be an important signal, but at this point, I honestly don't think that Trump and Republicans are worried about paying for these bills. I mean, what we hear from D.C. constantly is the market will have to move before legislators take, essentially the bond market, but more, I would say more importantly, long term, just the question of the deficit seriously. Legislators at this point, they can talk about the deficit. Some Republicans are certainly deficit hawks. But when it comes to are we going to pass Trump's agenda or not, I mean, frankly, they're going to do it whether or not it's deficit expansionary or not.
What's interesting to me is that late last year, people were saying ultimately one of the big checks on Donald Trump would be the stock market. And frankly, since the bond market had such a big impact on the stock market, the bond market as well. Are you saying that's not true? That actually what we're seeing in the opening salvos is the opposite? That actually is not a check at all? And that it's some of these larger issues that he's trying to get at that really will drive what he does?
Yeah, I think for one reason in particular, Trump is less focused on markets in this term and will be than he was in the last term. And that is he's not running for re-election, right? So it really is, he has 4 years to enact his legislative agenda, the policies that he's talked about now for 12 plus years. And I think any hurdle to that, is less important than it was 4 or 8 years ago. If there's a huge, significant market reaction, that's one thing. But Trump, at this point, I mean, he's talking about taking over Canada and Greenland. He's not answering to that many folks, right? That there are not many folks outside of the administration. Frankly, there are not many folks inside of the administration who are going to curtail the Trump agenda. Now, Congress might not be able to pass all of it, but they're not going to put up any roadblocks.
Just quickly, how big is this one big, beautiful bill going to be?
Really big, smaller than they would like it to be.
Is that a 6-handle? 7?
It's not 7, because I don't think a lot of the no tax on tips, no tax on overtime.
But you're north of 5?
Yeah, at this point, I think so.
Wow. All right. Rob Casey of Signum Global Advisors, thank you, sir. North of 5. And baseline for many people, we've said this a few times, you extend TCJA. That's 4 to 5 anyway, so what goes on top?
They might have to extend TCJA only for maybe 3 years and then go back and try to re-extend it again because they don't want to add that much debt.
Will the bond market be a constraining force on these ambitions? Yields are up this morning by close to 4 basis points. The 10-year 472. The 30-year getting closer and closer to 5% at 4.96. Up next on the programme, we'll catch up with the Republican Congressman Mike Lawler. That conversation just around the corner. Equity markets down across the board here on the S&P 500, negative by 0.4. On the Nasdaq, down by 0.5. On the Russell, the small caps down by more than 1 full percentage point. The why is on the next board. Switch up the board, turn the page and get to the bond market story. This is what it looks like. 10-year yields higher for 4 consecutive sessions. Yield levels we have not seen since November 2023. At the longer end on a 30-year, levels we haven't seen since October 2023. I want to point this out because I think it's really important. This is not just a US story, it's global. Check out the UK, the gilt yield, higher by 10 basis points, 4.78. And check out what's happening with sterling. You're not getting sterling strength off the back of this. Cable's down by 1 percentage point and changed, 123.35. That is an ugly picture for the British authorities this morning.
Because they don't have what the U.S. has, which is a strong dollar, and the fact that people still want to invest in the U.S. even at higher yields. And this raises a question How do they combat slower growth and high inflation? It creates a real quagmire for them.
What a ride 25 is shaping up to be. We're 8 days in. We're 2 hours until the cash open. Let's get you some movers. Here's Manus Cranny. Good morning, Manus.
Jonathan, good morning. And that whole conversation around bond yields really plays into big tech and duration. That's not a wholesale ransacking at the long end. That's just mild bearishness, not vigilantism. Apple this morning, some of these tech stocks are going to suffer if these yields continue to drive higher. Apple promised Indonesia that they'd spent more than $1 billion making the AirTags. That is not enough. This is actually Trump foreign policy in Indonesia. They say, you want to be here? You want to sell more here to 280 million potential customers? Build your factories here. Access is everything. Samsung are doing it. Xiaomi are doing it. So again, we're just on the back foot this morning overall on tech, down by 0.5%. Now, how do you lose friends and alienate people? Great book by Toby Young. D-Wave Quantum is up 1,000% last year. Jensen Huang, very useful quantum computers are likely decades away. 15 years away, that's when they become a possibility. Possibly 20 years away. That's how you lose friends and alienate people. I take you to Novo Nordisk. A couple of weeks ago, it came on, stood here, talked about CagriSema. This is one of their new GLP drugs. And the news there was down 29%, was you lost less weight than they had estimated you would get. Today, UBS say this is an attractive proposition. They move to buy from neutral. They do shave the price target to 750 Danish kroner from 1,100. The sell-off is overdone. Positive inflection point for GLP-1s. I mean, I can hear myself almost, rallying behind UBS here. Anyway, the point about it is, it's whether you think that a wipeout on that day is a sufficient entry point for you now. That's the trajectory for the moment. Jonathan.
That's Cranny. Thank you, sir. Appreciate an update there on some of the movers. Lots going on this morning. Equity futures session lows were down here by 0.4%. Under surveillance this morning, Canadian political leaders firing back at President-elect Donald Trump's continued comments about the US annexing Canada. Outgoing Prime Minister Justin Trudeau writing on X, quote, "There isn't a snowball's chance in hell that Canada would become part of the United States." Conservative Party leader Pierre Poilievre saying, quote, "Canada will never be the 51st state, period."
Well, I think what you see here, and I want to lean into the individual that likely is going to be the next Prime Minister of Canada. He was talking about in his statement that Trudeau didn't do a good job of explaining how much Canada helps the U.S. when it comes to things like oil and gas, agriculture. This is going to be a very interesting one to watch. I do think the Republicans just love trolling Trudeau, and I wonder if the relationship will change if it is going to be a new prime minister.
Well, I wonder exactly to that point, if this is sort of the goal for us to be talking about this with Trump posting on Truth Social. Many people in Canada love being the 51st state if Canada merged with the U.S. Together, what a great nation it would all be. Honestly, how much this is just trying to change the conversation to something that is not going to happen.
There's an important conversation to be had on some other issues, including this one. The incoming president also saying at a wide-ranging press conference at Mar-a-Lago that NATO nations should spend the equivalent of 5% of their economic output on defence, escalating his demands on European allies to more than double the current target of 2%, which many of those nations have fallen short on repeatedly over the past few years. I would say this, that I think some of the bond market moves, to an extent, not a great extent, but are a factor in what's happening here. They're going to have to spend a lot more on defence. And I'm not sure how much space they've got to spend on defence outside of places like Germany.
And they're going to have to spend a lot more defense, whether or not Trump basically pushes them to spend 5% of their budgets on NATO. This comes down to national security that's being threatened pretty directly by Russia. And so you have to imagine, at a place like Germany, if you look at boons, right now yields the highest levels going back, hovering around 2023. Because why? I mean, are they really dealing with an inflationary shock? It does pose that fiscal loop that we keep talking about.
It's at 2 now. He's talking about 5. Over the summer, I wrote about the Trump team eyeing 3%. And I think that's likely where this will end. So not as much spending as 5% of GDP, which I don't think the United States is at. It's not. But definitely more than the 2%. And he is going to make this a priority.
These are countries that failed to get to 2. They certainly struggle to get to 3. Never mind getting to 5. I want to give you an update on this. Los Angeles is ramping up evacuation orders as the Palisades fire continues to rip through the area. Parts of northern Santa Monica now under alert as widespread and damaging wind gusts threaten to worsen the situation. Tragic pictures coming in overnight.
Yeah, with evacuations being ordered all across different places. Honestly, I feel for them. It sounds like the winds are going to pick up. So hopefully everybody stays safe and this really does stop sometime soon.
We'll keep bringing you updates through this morning and and through today, of course. Let's turn back to politics. Republicans in Congress are gearing up to negotiate an extension of Donald Trump's 2017 tax cuts. A group of House Republicans were invited to meet with Trump this weekend at Mar-a-Lago and are expected to push to include an expansion of SALT tax deductions in Congress's upcoming package. I'm pleased to say that joining us now is one of those House Republicans, Congressman Mike Lawler of New York. Congressman, fantastic to catch up with you once again, sir. I just want to know from your perspective how many friends you have outside of New York in the House that would be on board with this effort.
A lot more than people realize. Obviously, New York, New Jersey, and California, three of the high tax states where this has most acutely impacted. Certainly, we have a coalition, and given our small majority in the House, it's certainly a powerful coalition. But there's other states and members across the country in which, over the last 7 years, they've seen their own taxes rise up against that $10,000 cap. So, quietly, there's a few more members than people would realize. Look, the cap on SALT was a pay-for the 2017 Tax Cuts and Jobs Act. That's it. It was used as a pay-for to pay for other provisions within the tax bill. The $10,000 cap is woefully insufficient. It's had a negative impact on states like New York. Now, we can get into how New York excessively spends. They've increased their state budget by $61 billion in the last 4 years, for instance. That needs to change. But taxpayers should not be penalized by living in a high-tax state. This is double taxation. And for those of my colleagues that say this is somehow a subsidy, the fact is New York contributes more to the federal government than it receives. And more than some of these states in which, my colleagues will claim that they don't want their taxpayers subsidizing New York. But the reality is it's the other way around.
Congressman, you certainly don't have a friend, though, in someone like Lindsey Graham, the senator of South Carolina, who said, why should I, from South Carolina, pay for what's going on in some of these blue states? And he's pushing for this for the two-bill approach, because he doesn't want to talk about taxes. He thinks it's going to take too long, and he doesn't, frankly, want to sign up for SALT. How are you going to convince the president this weekend that you should do one bill together and make sure SALT's included?
Well, respectfully, South Carolina is one of those states that gets more back, certainly percentage-wise, than New York does. So, if we want to talk about subsidies, we can go chapter and verse through everybody's subsidies that they get. Look, with respect to one versus two, the president has already made clear he is moving forward on one big bill. We need to deal with taxes, the border, energy, debt, among other issues. And the fact is, given our small margin in the House, we're going to need everybody's vote and everybody on board. Two track bills are going to make that harder. So while it may take a little bit more time to get one bill negotiated, it is necessary if we're going to get all of these issues addressed. And I think the president understands that. I think that's why the president made clear last week one bill, and that's how we are proceeding forward in the House. And look, ultimately, our Senate and House Republican majorities are going to have to work together. Nobody's going to get everything they want out of this. There's going to have to be a good faith negotiation if we have any chance of passing a reconciliation bill.
I was one of those individuals who watched your Festivus airing of grievances during the Christmas week, and you did a little bit of a wink at your potential future, maybe becoming the governor of New York. To make sure you could potentially go down that path, do you need to secure a higher SALT tax break?
Look, regardless of whether or not I run for governor, this was a promise of mine, and it's a top priority for my district. I represent one of the highest tax districts in the country, inclusive of Westchester and Rockland counties, number one and number two highest property tax counties in America. So this is critically important to lift the cap on SALT. $10,000 is woefully insufficient. And this is something that I said I would deliver on, and we're going to, as part of this reconciliation bill. Long term for New York, this is critical. We lead the nation in outmigration. Our tax base is eroding in large part because of the disastrous policies of Kathy Hochul and Albany Democrats. One-party rule in Albany has been an abject disaster, whether you're talking about the affordability crisis or public safety, people being burned alive on subways, pushed in front of oncoming subway trains, Kathy Hochul now scamming New Yorkers out of $2,500 a year just for the privilege of driving to work, while spending billions of dollars of taxpayer money on free housing, clothing, food, education, and health care for illegal immigrants. New York needs change. There's no question about that. But from a federal perspective, we should not be penalizing New York taxpayers because of the disastrous decisions of Kathy Hochul and Albany Democrats.
And just to be clear, when it comes to the SALT cap, how high are you looking for it to be raised?
Look, I've introduced legislation, my marriage penalty elimination bill reintroduced to raise it to $100,000 for individuals, $200,000 for married couples. This is going to be a negotiation. My colleagues and I are looking forward to sitting down with the president, having a discussion about it, hearing obviously what his priorities are as part of the tax bill, and working to a consensus. At the end of the day, my objective is to provide tax relief to hardworking Americans. It's incumbent upon everybody to negotiate in good faith, because here's the reality. If we do not pass a tax bill, number one, SALT comes back unlimited, but it is accompanied by the largest tax increase in American history. So it is important that we actually negotiate a fair tax deal for the American people.
In August, I just want to end on this. You were one of these individuals that wrote a letter to the speaker talking about that you didn't want the repeal of energy tax credits with the IRA. This is something that President-elect Donald Trump wants. Are you going to be trying to assuage him of your view over this weekend in Mar-a-Lago?
Look, many provisions of the IRA absolutely need to be repealed. What we signed on to a letter is that we were not going to just sign off on a wholesale repeal. There needed to be a discussion and, again, a negotiation. Companies make decisions based on tax provisions, and they need certainty. And there's already been significant investment, including in New York, based on some of these energy tax credits. And so we want to make sure that any changes are done smartly and not just wholesale repeal. So that'll be part of the discussion and conversation as we move forward. Again, I think the key here is to come up with a reconciliation bill that increases domestic production of energy, ensures the American people have a good, smart tax bill to reduce their taxes, reduce the cost of living here in the U.S., and ultimately secures our border. It's a lot of important issues that have to be included in this reconciliation bill. It's going to require negotiation, and it's going to ultimately require every Republican supporting the final product.
Congressman, as we speak, bond yields are climbing, and we've seen quite a significant move since September when the Federal Reserve started its rate-cutting effort. We've moved 100 basis points, and I certainly don't expect you to follow the ins and outs of fixed income on any given day, but I wonder whether you and your colleagues are sensitive to some of the pressure that's starting to build in the U.S. debt market.
No question. Look, our debt at $36 trillion total and counting is a major problem. And this is something that everybody in the Republican conference is in agreement on. We have to tackle our debt. We have to reduce our deficit spending. We have to right-size the federal government. Spending is out of control. Joe Biden's disastrous first 2 years gave us record inflation. It spiked the cost of living, and we have to unwind a lot of this. You look at a state like New York, it is floundering because of some of the economic pressures. And just think about this. The MTA has more debt than 80% of the states in the country. So debt is a major problem. It's something that we have to deal with across the board. We cannot continue to print and borrow money at the levels that we have.
Do you think we can afford to extend TCJA which baseline is something like 4 to 5 trillion. Do you think we can afford to include an expansion of SALT tax deductions? And Congressman, I wouldn't push back against anything you said about the effort that needs to take place elsewhere. I'm just wondering how much fiscal space you and your colleagues believe we actually have at the moment.
Look, tax policy is critical to economic growth, but it's one part. We need to increase domestic production of energy, which will help generate more revenues. Energy policy is also critical, not just domestically for cost, but for national security. You were talking, obviously, about the threats to Europe from Russia. Europe is still buying gas from Russia. It's idiotic. It makes no sense that they're helping fund the very war they're trying to stop. So there is a lot that has to be done here, including reining in federal spending. Obviously, as we work through the tax cuts, we will look to help offset some of the cost through spending reductions. So this is going to be a comprehensive approach to how we right-size the American economy. I do think it's possible. It's going to be one of the most critical things any of us ever do in our careers in government. And so we all have to be committed to the final cause here.
And we're certainly looking forward to continuing the conversation with you, sir, in your current capacity and maybe in the future as the next governor of the great state of New York. Mike Lawler there, Congressman. Thank you, sir. Appreciate it. The 10-year yield this morning up by 3 or 4 basis points. The 30-year up by 5, Bramo.
Yeah, question about whether the math works for the bond market, because right now people are trying to understand how do you offset the extension of TCJA at the same time when you're not going to necessarily cut Medicare or Social Security. And this has been really the needle that it's been very hard for people to thread.
I said this earlier this morning. The UK Treasury, the finance minister in France, they're all going to be watching payrolls on Friday, because they do not want yields to push any higher from here. And I would also suggest they're all going to be watching the effort in Washington, D.C., the package they come up with, the size it is, because I really believe that the crowding gap, the global bond market, is a real force taking place right now.
And they're going to be watching at 1 p.m. today when $22 billion of 30-year bonds in the U.S. are going to be sold at a time where 30-year yields are currently at the highest level since November of 2023, pushing up against 5%. How messy is this? And that's really going to set the tone around the world.
This conversation continues up next on a program higher for a whole lot longer.
Normally, the textbook would say if you cut interest rates, long rates should also be going down. It is just really unusual that long rates are going up when the Fed is cutting.
That conversation up next. Another interesting move in the bond market. Another day for it. Yields are higher by 3 basis points on a 10-year, 4.72. Under surveillance this morning, higher for a whole lot longer.
Normally, the textbook would say if you cut interest rates, long rates should also be going down. It is just really unusual that long rates are going up when the Fed is cutting. Markets are pricing that rates will stay higher for longer, and therefore we will not get all these cuts. The backdrop is that the economy is still strong. But the bad news, of course, is that rates higher for longer will continue to weigh, in particular, on balance sheets that are weaker.
We've had a 100 basis point move since the Fed started cutting interest rates. Padhraic Garvey of IG writing, as we progress through 25, our vision is for the US 10-year to head towards the 5 to 550 range. Padhraic, good morning. It's good to see you.
Good to see you, John.
What's behind this move over the past few months, the past few weeks?
A whole combination of things. But before we get to that combination, I think it's important to have context. I think one of the things that we can't just throw numbers out there. It's easy for me to say 5.5%. But the starting point here is that when you look at the Fed funds rate, fair value neutral is 3%. When you look at the 10-year fair value neutral, I think is around 4%. That's for SOFR. Treasuries trade 50 basis points above that. That's 4.5%. That's your starting point. I've spent the last 18 months convincing people that a 4% plus handle for 10-year Treasuries is not a high level. So you start at 4.5% and you ask yourself, where should it be given all the other factors that you have referenced? So fiscal deficit, inflation issue that's not solved, economy doing okay, and ambition from the current or the coming administration to cut taxes. All of that is in the mix and it's pushing up yields.
So does this mean you're not going to be buying today at 1 p.m. when the U.S. Treasury sells $22 billion of 30-year notes?
No, there wasn't much buying yesterday in 10s or the previous day in 3s. There was a 1 basis point tail at all of those auctions. Now, let's suppose today's auction goes well. It doesn't change anything. Yesterday's auction, I think, was the big one. That's the benchmark point, the 10-year point of the curve. So today is less important for me. We've had a decent concession today based off very little. The concession yesterday, at least, was based off some firm data.
The reason why I ask is because there's a real question of how much the increase in yields is directly tied to the potential supply that could come down the pike. How closely attuned are you to the size of the bill that gets passed in Washington, D.C. to decide whether it's a good idea to buy 10-year treasuries at 5 or 5.5 or just to sit out entirely?
Yeah, it's absolutely crucial. It really is, because one of the things that we know with clarity at the moment is that there isn't a credible plan out there at the moment to cut the deficit. And we're sitting in an economy with a 7% deficit. Now, Brazil is sitting in an economy with a 7% deficit and is getting crucified. We're not, because we're the US, we've got the reserve currency and we've closed our eyes. But at a certain point in time, it becomes important. And I think we're beginning to see the beginnings of a creep of this type of psychology.
Is it a problem for everyone else before it becomes a problem for us? We're seeing some big moves take place in the UK, bigger moves in the United Kingdom, likewise in France. Is it a bigger problem for them than maybe it is for America?
As it always is with the US, we have such a huge impact on the global scene. We saw gilts hitting, local highs yesterday, significant highs. And you could argue even in the Eurozone, rates are higher than they should be under normal circumstances when you look at the economy, which is very weak. So there's a huge correlation trade out there. So yeah, for sure. And it has to be said that the US economy has taken this rate hike process remarkably well. I know we're cutting now, but the rise in yields as well, it hasn't toppled anything. So as long as that continues, there's a kind of a path for that to continue.
I think we've got to recognise that because it's important. We've handled these rates at these levels across the board at an aggregate level in a much better fashion than I think many people anticipated all those years ago when this process started. Which,
again, goes back to the ultimate question of, is this really very restrictive in terms of policy from the Fed if there isn't evidence of its restrictiveness in the outcome of economic growth?
Some big moves in this bond market worldwide. Padhraic Garvey there of ING. Padhraic, it's good to see you. 10-year yields are up by 3 basis points. The 30-year is up by 5. In America, the US 30-year, 4.96. Alicia Levine of BNY Wealth is going to join us shortly. We'll catch up with George Gianarikas of Canaccord, Greg Daco of EY, and Winnie Cisar of CreditSights. All of that and more in the third hour of Bloomberg Surveillance.
Our base case is for volatility, episodic volatility.
Primary trend is up, but it's going to be delicate. There's going to be some things that are likely broken.
That top 20% of momentum is now starting to just be a little broader.
I worry about a 10 to 20% drawdown this year if inflation does in fact look like it's being sticky or moving up.
I don't know that I look at 2025 and see another 20-odd% return in the equity market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now. So yesterday, the economic data shook up this bond market big time. This hour, we'll get the ADP employment report at 8:15, so about 15 minutes from now. 30 minutes from now, we'll get jobless claims, of course, brought forward a day because of the funeral of the late President Jimmy Carter. So look out for that number at 8:30 Eastern time. The estimate in our survey, 215, the previous number, 211. Just to get you up to speed, if you are just joining us on the price action taking place, not just in the United States, but worldwide. Equity futures on the S&P 500 negative by, let's call it 1/10 or 0.2%, bouncing off session lows. We've got the Russell down by 0.75%. In the bond market, some significant moves, not just stateside, but worldwide. Yields are up by 2 basis points on a 10-year, through 470. On 30s, we're getting closer and closer to 5%, 495. But we're seeing bigger moves elsewhere. Look at the UK. Yields are up by 9 basis points on 10s, up 6 on 50s, up 9 on 30s. The long bond in the UK getting absolutely slaughtered.
And this comes at the same time that you're seeing a pound that's losing steam versus the dollar because they don't have the privilege that the U.S. has of being the fiscal currency of choice. Issue here around the world, and you've mentioned this many times, as U.S. sees yields creep higher, how much does that shift the entire global yield curve higher than it otherwise would be based on growth and based on inflation in places like Europe that right now are not seeing the same kind of momentum as you have in the United States?
These are places that already didn't have much fiscal space, and they're arguably being constrained by US data, by upcoming US policy, and we're going to see those conversations ramp up in a week ahead as we go into inauguration. A big, powerful bill down in Washington, D.C. is arguably not going to help the debt fortunes of the British or the French, for that matter, and others too. How big is this bill going to be?
Well, Bob Casey, Jonathan said it to you, somewhere between maybe $5 to $7 trillion. That's how much this bill could cost. What they're talking about is money for immigration, energy, TCJA getting extended, maybe also adding some extras like no taxes on tips. We still don't even know how the sausage is going to be made because the president-elect said yesterday, Trump said, well, he likes the idea of one big beautiful bill. Maybe it'll have to be two. Wall Street Journal editorial board this morning. Will the real Republican legislative strategy please stand up? And even if Trump comes out today and says, you know what, I talked to the senators, I agree with them, we're going to go this two-track approach. He's then meeting with a bunch of House reps over the weekend. So by Monday morning, it could be a completely different narrative.
One message, though, is standing up. And this is the message the bond market is getting. And that's what Padhraic Garvey just said, which is there hasn't been a credible plan to reduce the deficit in any of the sausage making. And that is what's getting the attention right now of some of the vigilantes.
And Lisa, you brought up a great point earlier this week. How much money the United States already just paid only on paying off its debt? The interest payments last year was what, $1 to $1.5 trillion? Unless you start looking at actually cutting Social Security and Medicare, we are not going to get our fiscal house in order.
There's an important point to make here, though, that the United States of America will benefit from the deficit spending that we do get from the upcoming administration. We will see the growth in America. The issue the rest of the world has is that the walls are going to go up. And if tariffs go up, you're not going to get the positive spillover to places like Europe, to places like the United Kingdom. They won't benefit from it. They'll just suffer, and they're suffering this morning.
And that's why people are looking at some of these yields that might look higher on an absolute basis in the UK and say, do I really want to own that, given some of these extra concerns and the fact that it's not going to stimulative spending that's going to actually boost growth?
Lots of economic data coming up a little bit later. The ADP report, the next stop. Coming up this hour, we'll catch up with Alicia Levine of BNY Wealth as a cross-asset sell-off takes a breather. We'll catch up with Canaccord Genuity on why they're still bullish Tesla despite the recent pains we've seen, and Greg Daco of EY on the Fed's policy tightrope in 2025. We begin this hour with stocks steady, recovering after a bond market sell-off hit equities just yesterday, erasing recent tech-fueled gains. Alicia Levine of BNY Wealth staying optimistic. We expect more volatility than in 2024, but also a positive year because the consumer is strong. Earnings growth will be in double digits, and the Fed, though pausing for now, still has a cutting bias. Alicia joins us now for more. Alicia, good morning.
Good morning.
Happy New Year. It's good to see you.
Year.
How constrained is your view, given the moves we're seeing in this bond market?
So I think the bond market here is pricing in the worst case scenario for what the upcoming administration could or might do, which I don't think is necessarily a bad setup for the rest of the year. In the end, the talk about tariffs on everyone and everything and every border that we might have, whatever those borders might be.
Some of those borders are just imaginary lines, particularly that one up by Canada.
But the truth of the matter is, whether it's a negotiating tactic or not, that is the conversation. And so the anxiety about that is seeping into the bond market. And I think just want to refer back to the Fed press conference back in December, where Jay Powell said some of the voting members and the dot plotters incorporated future policy, which is very rare because we never hear that from the Fed. We never hear that they're chasing the puck of what policy might be. So the Fed is baked in already in the dot plot and its communications that it's expecting a more difficult path for inflation. The market has priced it in. And then on the policy side from the upcoming administration, we're going to have tariffs on everything front and center, even if they are a negotiating tactic, because you need it for the negotiation piece.
We should
and
say
you put
this
the two things together, it creates anxiety in the bond market.
It makes the Fed minutes a little bit more interesting later on this afternoon.
That's right. That's right. So we'll hear perhaps who and what and why. But I will say that the incorporation of future policy as yet unknown is very unusual. And I think we should just take all of it with a little bit of a grain of salt.
What are your trade assumptions right now on tariffs? We've had conflicting reports from the Washington Post. We've heard from CNN this morning. I'm struggling to find the news in some of this. The president himself has said that it's all fake news, that ultimately he's got a big job in front of him and he wants to get it done. What are your underlying assumptions?
Our underlying assumptions, which is why we're still bullish, is that the China tariffs happen, and they'll probably happen right away, and that rest of world will be a negotiating tactic, but will sound very ugly and it will sound as if it's not great for the inflationary picture for the U.S. In the end, I think what we have to keep in mind that there is a Fed put and there is a Trump put on these markets. And we know that the upcoming president cares very much about the performance of the market. And he was elected because of inflation. And he's got some serious folks in the Treasury Department, and I think we have to remember that. So as the bond market is pricing in anxiety about what policy might be, or the better than expected growth, so a no landing rather than a soft landing scenario, this economic team is going to have an eye on inflation. So it's not just the bond market and investors, it's the administration as well.
It just feels as though you're in the market buying pretty aggressively at a time when everybody else is finally feeling a little bit of fear for the first time in months, maybe even years. Is that the case?
I love fear.
Okay.
We love fear. I mean,
all right.
We don't want to be here and all be on the same side of the boat. Like, we know that is the worst place to be. So I welcome the conversation that there's a two-sided trade. What do we know? We know we have an administration that's going to cut regulations, that's going to keep corporate taxes low, keep the individual taxes low, and has unleashed small business optimism. That's what I know. Earnings are meant to be double digits. We have a very rich multiple. I'll give you that. But if earnings are in double digits, we should have a positive year this year in the S&P, and our estimates reflect that.
Just how contrarian are you? Russell 2000?
That's a tough one.
Well, I was just wondering, what kind of fear are you buying into right now?
So I would say this. I think the giving up on rest of world and the giving up on the small cap, again, is the one side of the boat trade right now. And we would welcome, getting a little bit more exposed to these areas. We did not follow the small cap wave last year because we felt that rates were ultimately going to stay higher. And that's very difficult for the constituents of the small cap world because there's no earnings growth there. So the small caps really need a change in Fed policy. So we didn't follow that. I'll say this. There's such disenchantment with the small and mid-cap space. And there's such disenchantment with rest of world, with the strong dollar. That's when it gets interesting. We have to be contrarian on some level. And so I think that's where we'd be, that's where we'd be a little bit more open. The whole world hates it. Maybe we want to go to the other side of the boat.
Alicia, you talked about the fact that the negotiating part of all of this with Trump is going to sound ugly.
Right.
Amidst all of that, is there a concern that even if it's just language and threats, there could be economic deterioration from it?
I think we've seen some of that. I think some of what we've seen in the data is pre-buying before tariffs hit. I think some of the negative data in Europe is because of pricing in a more difficult trade environment. So yes, it will have real world consequences. I think ultimately, though, if you look over the space of 12 to 24 months, I don't think tariffs at the border are going to happen because it's going to threaten the entire economic agenda.
How insulated is the United States? Are there negative feedback loops from the rest of the world? Chinese growth is struggling. Chinese yields have fallen off a cliff, reflecting that. We're looking at the struggle play out on the debt side of things in the UK. That's going to constrain them. Constraints across the board in Europe on a whole range of issues. Is there any kind of feedback loop into the US economy?
So it's really interesting because in some ways, the real economy, the US economy, is something of an island. And we learned that in 2018 with the tariffs, which seemed so shocking at the time and actually did very little to affect the US economy. The equity markets, on the other hand, are exposed to rest of world. And so, you need the rest of world not to be in recession to have the S&P hold up. So the real economy is an island. The S&P is not an island. And we've always talked about the fact that the equity market is not the real economy. You need the economy strong enough to provide earnings. And the S&P, of course, is much more manufacturing based than the real economy is.
Yep.
So if you have a reignitement of manufacturing in the U.S., an acceleration of reshoring, it should help earnings in the manufacturing sector as well. And we saw it with the ISM numbers, new orders above 50 for the second time in a row. So that's really great. It tends to be an arbiter of future S&P earnings because the index itself is more exposed to manufacturing.
ADP up next. Alicia, well framed. As always, it's good to see you.
Nice to see you guys.
Thanks for catching up with us. Alicia Levine there of BNY Wealth with an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. OpenAI rival Anthropic is said to be in advanced talks to raise $2 billion in a funding round, giving them a $60 billion valuation. Our sources say that Lightspeed Venture Partners is leading that round. Amazon also said in November it was investing an additional $4 billion to boost its stake. Indonesia has decided to keep a ban on the sale of Apple's iPhone 16. Apple had announced a $1 billion plan in the country that included building out an AirTag factory, but Indonesia said that was insufficient to meet local investment requirements. The government is willing to negotiate with Apple, but may impose sanctions if the company does not comply with those local investment rules. A familiar face is emerging as the candidate for the next head coach of the New York Jets. Rex Ryan interviewed with the team on Tuesday after lobbying for the job in recent media appearances. Ryan coached the Jets from 2009 to 2014, winning 50 regular season games and coaching the Jets to their most recent playoff appearance in 2010. He's the third known candidate to interview so far for the job. And that's your brief, John.
Make Halarian the fourth.
I was thinking that.
Make Mohammed the fourth. Why not?
Imagine. I mean, I could see it in addition to everything else.
He was against the Aaron Rodgers move. Turned out to be right. Mohammed's got a good read on these things.
Hold on a second. So he's going to be coaching the Jets. He's going to be running the Fed. What else is he going to be doing? Let's just get this on the table.
Join this program.
On Friday. He'll be here, so we can run all this by him.
Friday morning. Watch out. Up next, the Morning Calls Plus, George Gianarikas of Canaccord Genuity on why he's still bullish on Tesla despite recent setbacks. Before we get there, an ADP report just moments away. The ADP report out just moments ago. Bit of a downside surprise. Mike McKee has the details. Morning, Mike.
Good morning, John. ADP would see a disappointing result on Friday. They see 122,000 jobs created during the month of December. That's lower than the 146 they had originally reported for last month. We're looking for the revision on that. It's lower than the 140 that economists anticipated. Right now, they're saying that private sector jobs, which is the 122, are much lower than anticipated by the Bloomberg consensus for Friday. The service-providing jobs, according to ADP, 112,000, goods producing only 10,000. So a rather weak report from ADP. We'll see what we get on Friday.
Mike McKee, thank you, sir. Helping to put a lid on this bond market sell-off, at least for now. 10-year yields now well off session highs, up by just a basis point and dropping just below 470 on a 30-year yield. Been very focused at the long end of the curve, levels we haven't seen for quite a while on a 30-year. Yields are up by 3 basis points still to Lisa around 495.
This really goes to the point that Andrew Hollenhorst is making, that even though you're not necessarily seeing the layoffs, you're not seeing the hiring. And that's the reason why people are saying, wait a second, maybe things aren't running away with growth and inflation for a hot second, but still not making a dent because ADP doesn't tend to portend much for payrolls that come out on Friday.
Well, we can talk about the big one on Friday. 163 is the estimate. Andrew's at 120. Andrew basically suggested to us that the more important data point was unemployment. Unemployment in our survey is expected to stay at 4.2%. Andrew thinks it climbs to 4.4%. And if we get a move like that, Mike Schumacher over at Wells Fargo, and we talked about this a little bit earlier, he thinks you could have a yield move the other direction in the other direction of as much as 20 basis points on a single day. So stay tuned Friday for some big moves, maybe.
You know, this goes to the point of Bill Dudley, which is how much is this an issue with Fed communication? And it raises the point of the minutes that we get later today, because the Fed keeps reiterating we are not data point dependent. So ostensibly, they shouldn't necessarily completely shift their call on one payrolls report, and yet the market is moving as though if you get a 4.4% unemployment rate, you could get a rate cut as soon as later this month.
Equity market on the move, improving just a touch. We're down by a couple of tenths of 1%. The opening about 1 hour and 12 minutes away. Let's get you some morning calls. First up, Wolf Research upgrading UPS to outperform, expecting a positive margin inflection this year. Next up, TD Cowen upgrading Coca-Cola to buy, citing more upside in international markets over the long term. And finally, HSBC downgrading AMD to reduce from buy, pointing to competition in the AI GPU market. Their stock is lower by more than 2%. Let's turn to tech. Tesla down over 8% since the start of the year as weak sales and bearish sentiment weigh on the stock. Despite the automaker's recent turmoil, George Gianarikas of Canaccord Genuity maintaining a buy rating, writing Tesla has a generational set of growth opportunities ahead, including EVs, autonomy AI, energy storage and robotics. George joins us now for more. George, welcome to the programme, sir. Good to catch up with you. Deliveries in the past week or so. Are we playing down the importance of them, just saying that things elsewhere are better than expected? Why would you ignore those?
Well, first, if you look at the delivery cadence or the year-over-year growth cadence in 2024, the stock sort of magically bottomed when the year-over-year growth rates bottomed in the first quarter of the year. You look at the next few quarters, that year-over-year growth rate improved. And what's important for the stock, super important for the stock, is that we expect that year-over-year growth rate to continue to accelerate into 25 and to 26, mostly based on new products. Elon Musk has promised investors new products. Hopefully sooner rather than later. That should impact the fundamentals probably in the second half of the year and into 2026. So what we've decided to do is be forward-looking and look at the year-over-year growth rates that have really impacted stock performance for the last several quarters.
How much, George, does the potential for deregulating some of the parameters around full self-driving technology really underpin the reason why you have a buy on this?
It's very important. So Tesla's FSD, full self-driving, has had not that great take rate so far. And take rate basically means if you buy the vehicle, are you going to opt to pay the $8,000 to get their full self-driving? Now, their gross margins have been terrible for the last couple of several quarters because they cut prices. So what we see into 2025, 2026, 2027, and beyond is an improvement in those take rates. If you pay attention to what's happening on the internet, people are very excited about FSD version 13.2. So as people hopefully increase their penetration and their take rates of that full self-driving software, the gross margin should get better, and therefore the product becomes more sticky. And so what we've called Tesla's strategy, at least with its current vehicles, is a razor blade. You sell a bunch of vehicles, and over time, each one of those vehicles has a potential to upgrade the software and have very high margin take rates for FSD in the future.
Some stocks are stories, and Tesla is one of those stories. And so I'm curious about the parameters of this story for you, George, in terms of, say, 1 year, 2 years out. What do you envision in terms of the way we drive, whether we have basically self-driving taxis that pick people up and that a lot of people don't have driver's license anymore? Can you give us a sense of what your time frame is for a full transformation of our imagination with vehicles?
So as a father of 2 teenage girls, I am incredibly excited about a future where they don't have to drive. So first and foremost, we are very bullish on the long term of autonomy, and we cover several stocks in the space, including Tesla, Mobileye, another company called Aurora. And we think that each one of those has the potential to be wildly successful, but for different reasons. Tesla has decided to take on a camera-only neural network approach that is costing them tens of billions of dollars. Aurora is in Class A trucks, and Mobileye is also trying to be what we call the Android of autonomy. We see a future, to your point, where people don't have to drive as much anymore. It'll happen progressively. It's not going to happen all at once, but we think that unleashes productivity from a passenger vehicle perspective, and from a Class 8 trucking perspective, it increases resource utilization. Trucks are able to travel 24/7 mostly, decreasing shipping times. We see full self-driving or autonomy broadly as one of the generational investment opportunities that are ahead of us. It's one of the most exciting tech opportunities over the next 5 to 10 years. And if you listen to NVIDIA yesterday, Jensen's CES speech, he said exactly the same thing.
George, I got to say, you sound like my dad, who refuses to get in the car if I'm in the driver's seat. But this sounds all rosy and exciting, but 2025, there's a lot of risks ahead. EV tax credit, and of course, what can happen with China, especially when it comes to a potential tariff policy, new regime from the incoming Trump administration. How are you thinking about that amongst your very rosy outlook for Tesla?
You're totally right. So EV tax credits are a risk. China is a risk. It's a wild card. We have no idea if that'll impact Tesla, really. And that was in 2024, we calculate about 37% of their deliveries. So lots of unknowns. But what we're counting on to help re-accelerate that revenue growth are new products. And Tesla has a tendency to deliver new products that are very exciting. To the extent they introduce them sooner rather than later, which we expect, and they start to really positively impact the P&L in the back half of the year, those are idiosyncratic things that can help Tesla buck the trend relative to whatever happens with EV tax credits in the U.S. and hopefully any marginal decline in China, if that happens.
George, can this multiple survive in the face of 5% interest rates?
It's a great question. So what we comp Tesla to are some of the large cap tech peers. So we looked out to 2027. We saw, many of them or all of them collectively trading around 23 times 2027 earnings, and they're growing at half the rate, if not less than half the rate of Tesla, right? If you look at earnings and EBITDA. So if Tesla's going to grow multiples of that and continue to grow multiples of that based on opportunities in autonomy, energy storage, robotics, we think it deserves a much higher multiple. So really depends on what its comps trade at, but its comps are trading at healthy multiples too. So it deserves to trade at a higher multiple given what we see as better growth prospects.
Appreciate your opinion this morning. George, thanks for your time. George Gianarikas there of Canaccord Genuity on Tesla. The bond market just paring losses a bit, yields off session highs. We had this from Governor Lawler a little bit earlier this morning, speaking moments ago, saying that tariffs are unlikely to impact his view on monetary policy, doesn't expect tariffs to have significant impact on inflation, and will support rate cuts in 2025 if the outlook comes in as expected.
So to me, he wasn't one of the people who were putting this into their forecast. I wonder how that sets him up politically going forward.
I'm not going to question his intellectual honesty. I would say perception matters, and some people might perceive this as an individual setting themselves up maybe for a vacant seat on the FOMC in a few years to come.
Yeah, is that 2026? Maybe.
They call that an audition.
Perhaps. Watch this space. Jobless claims up next from New York City. This is Bloomberg. Initial jobless claims data just seconds away. The estimate in our survey is 215. The previous number is 211. We'll get the number in just a moment. Going into it, the scores look like this. Equity futures on the S&P 500 just about unchanged. Likewise on the Nasdaq, recovering from losses from earlier on in the session, driven by lots of different things. You can point to a headline from CNN, or you could point to the bond market and see the moves there. Let's check out the bond market just briefly. 10-year yields are off the highs. We're up by just 2 basis points. The 10-year 470. With some stunning jobless claims data, let's get back over to Mike McKee. Hey, Mike.
Hey, John. Well, the numbers released a few seconds early show a big drop in jobless claims last week, 201,000, down from 211. The forecast, as you mentioned, was for 215. Now, this is the time of year when we do get a lot of weird readings in jobless claims because of the holidays, as the government tries to adjust for Christmas hiring and Hanukkah hiring and the whole holiday season. But this does suggest that at this point there is as good a chance of a strong report on Friday. This doesn't affect this is way after that, but the labor market's not in trouble.
Mike McKee, 201 is pretty stunning. Just give us sort of some historical perspective here. The low 200s on jobless claims is one thing, but 201, we're basically looking to break below 200K. Where's that come from?
Well, at this point, I'm guessing a lot of it has to do with the seasonal impact. The numbers were expected to be much higher. And if I take a look at the unadjusted number, the seasonal factors had expected an increase of about 35.6 thousand from the previous week. However, there were only 300. There were only an increase of 21,000. So the numbers were pushed down by the seasonal expectation for a much bigger number. And that's why you end up with this slow number. It is the lowest since February of last year when we hit 200,000.
Mike McKee, thank you, sir. Looking ahead to payrolls. Payrolls come on Friday, of course. The estimate in our survey, just a sneak peek for you, 163. The high is 234. The low is Andrew Hollenhorst of Citi, who was with us a little bit earlier. Andrew's looking for 120. That number, of course, coming on Friday morning.
So here's the difficulty with this data. We just got ADP employment change that underperformed, and that's sort of the slow hiring that we've heard about. And you're also seeing slow firing. This is sort of that stagnancy that people talk about. How do you interpret this? Is this a positive, really healthy market, or is this one that just is kind of treading water before there's a big change? This comes especially as continuing claims actually crept higher. So you look at all of these different aspects, and it's very hard to put them together with a cohesive narrative that can be consistent.
Let's get the view of Greg Daco of EY. Greg joins us now. Greg, you heard Lisa's question. How do you make sense of all this right now in the labour market?
Yeah, I think what we're seeing is a frozen labour market, one in which we're not seeing much hiring, we're not seeing much quitting. If you look at the JOLTS report yesterday, both the hiring rate and the quits rate were at a 10-year low. That tells me that a lot of business leaders are hesitant to move in any direction in terms of laying off individuals or in terms of hiring. And that means that a frozen labour market is unstable, because we could either see a further deterioration in labour market growth, which would directly affect income and consumer spending, or we could see a resumption of stronger confidence, which could lead to stronger hiring and stronger income growth. Policy direction over the course of the next few months is going to be key in determining which side of the ledger the employment market falls.
Can you elaborate on that? Yeah. Which policies have the greatest potential to move the needle when it comes to defreezing the labor market?
Well, I think we have a couple of policies that are likely to have an immediate effect on the labor market: regulation and immigration. Those are two key policies that will have a key effect on the labor market. Regulation, because it could lead to a pro-business sentiment environment where you see greater hiring and greater investment on the back of this deregulation tailwind. Immigration restrictions are likely to be hurtful in terms of the labor market, because they will restrain labor supply, which has been a key driver of employment growth over the course of the last 2 years.
You know, historically, people take a look at the labor market and they say that it's actually a lagging indicator, that actually it lags behind the business cycle by a good year, sometimes even 18 months. Are you saying this time is different, that it's actually more of a leading indicator because of the fact that it has been so dislocated post-pandemic?
No, I think what's different is the fact that conditions today are very different. Supply conditions are increasingly driving economic activity. Labor supply has been a key driver of employment growth, and that's very different than in the past. In the past, demand factors were the key drivers of economic activity. But since COVID, we've seen supply be much more important. And the value of talent is much greater than it was pre-pandemic. A lot of the different CEOs, CFOs that we talk to across multiple sectors highlight the value of that talent. They struggled so much to hire the right type of individuals, to train them, to increase productivity in terms of these higher costs and offsetting these higher costs, that they don't want to fire them. They're allowing attrition and performance-based judgment to guide their strategic decisions in terms of how to manage their workforce. And that's really key. And that's a key difference relative to prior business cycles, where the first resort for business leaders was to lay off massively at the first sign of a slowdown.
So what you're waiting for in terms of understanding the labor market is really political economy. What are going to be the policies that take place? And when you start thinking about fiscal sustainability, what do you make in what we're seeing, what we've been talking about for 3 hours, the move in bond yield? Is that because of this uncertainty about how Washington is going to enact Trump's agenda?
Yeah, I think there's a lot of uncertainty with regards to what's happening in terms of bond yields. You've had the Fed cut rates by 100 basis points, be extremely and too reactionary, in my opinion, but you've seen long-term bond yields actually rise, and that's likely a reflection of the expectation of higher inflation with deregulation, immigration restrictions, trade and tax cuts that are likely to be inflationary, but also the direction of travel of the budget deficit. We have a situation in which the budget deficit is currently around 6.5% of GDP in good times. That is not normal. And if you look out the next 10 years, we're going to be in an environment where budget deficits are going to average 6.5–7% of GDP. That is going to continue to pressure up long-term yields and could be a catalyst for a risk-off environment that could be negative for growth.
Can the U.S., though, act that way?
In terms of fiscal sustainability, that's a key question. I mean, one of the three arrows that Besant put in place is this notion of bringing back the budget deficit to 3% of GDP. What does that entail? That entails cutting the deficit by over $1 trillion per year over the next decade. That's a massive reduction in government spending. Now, this could be done if we think about entitlement programs, if we think about tax reform. I don't think that's necessarily where we're going. We're talking about potentially massive spending cuts, but let's not forget that if you cut spending, you also cut economic activity. So you have to be consistent in your messaging in terms of ensuring that reduction in the budget deficit while sustaining economic growth.
How concerned are you if there is a dojification of the government and you do get some massive job cuts or mandates that cause people to quit in a massive way? How much does that affect some of the labor pictures that people are looking at, especially considering how much government hiring accounted for some of the recent job gains?
Yeah, I think there are 2 points there. First, you're absolutely right. Government hiring has been a key element driving employment growth. Month after month after month, we've seen government sector hiring in terms of education at the state and local level being a key driver of employment growth. But the other big thing in terms of what could happen when you have massive spending cuts is, or at least proposals for massive spending cuts, is that they might not necessarily be implemented. We should not forget that about 15 years ago, the Simpson-Bowles Commission had this intent to reduce government spending, and the proposals were largely drawn down. Now, you did have the Budget Control Act in 2011 that led to a freeze in government spending with sequester threats over the course of a decade, but that was much less than what was initially proposed by the Simpson-Bowles Commission.
Just quickly, what's your reaction to Governor Lawler this morning? Tariffs unlikely to impact his view on monetary policy, doesn't expect tariffs to have significant impact on inflation. Just a quick reaction to that to round things out.
Tells me there's a lot of uncertainty in the economic projections from the Fed. The Fed Chair Powell mentioned that some policymakers had included policy shifts in their projections, some hadn't, and some weren't sure. So there's a lot of uncertainty as to what is really contained in these economic projections. That's a big issue, in my opinion, in terms of Fed communication, because a Fed that is highly reactionary, but for which you don't know which policymakers is including what, is highly doubtful in terms of the trust that you can put in these projections.
Fed Minutes coming up a little bit later. Greg, it's good to see you. Greg
Always a pleasure.
Daco there. Thank you, sir. Mike McKee still with us, our economics and policy correspondent here at Bloomberg in the nation's capital. Mike, I want your thoughts on Governor Waller's headlines this morning from that speech and what you're expecting to see in the minutes later this afternoon.
Well, I think Greg kind of tied the two together when talking about what we might see in the minutes being some explanation for why some people were looking for an impact from Trump fiscal policies and some people were not. That's confused a lot of folks on Wall Street. What is it that you're actually predicting here in your summary of economic projections? I think Governor Waller's situation, you suggested it could be an audition, and maybe it is. But on the other hand, in the past, tariffs have not necessarily been inflationary, depending on how they're imposed. They are generally a one-time rise in the price level. We saw Donald Trump impose tariffs on China, on steel worldwide in 2018, and there was no appreciable effect on inflation. It depends on what's tariffed and the time frame of the tariffs, whether it keeps pushing prices up or not. So he might be right about that.
Mike McKee, appreciate your perspective as always. Mike McKee in Washington, D.C. I should also point out, of course, and Mike McKee knows this, that Governor Waller appointed to the board by President Trump in his first term. So perhaps a front runner of people on the board to think about who could be the next Fed chair.
There's a broader point here, and I think that we can all agree on this, which is that at this point, there is a question of how politically independent an organization can be looked at when there is a sort of speculation hovering over it, and you have the president talking, or president-elect talking at his press conference in Mar-a-Lago, not just about Denmark and Greenland, but also about how rates are too high and how the Fed should do something about that.
Let's have the market conversation now with Winnie Cisar of CreditSights. Winnie, welcome to the programme. A lot of people came into this year thinking about credit, and they all said the same thing. I'm bullish. They didn't like where spreads were, but all-in yields were attractive. You weren't one of those people, Winnie. What did you see that makes you think things are different?
Yeah, good morning. We are definitely a little bit contrarian on the credit markets right now, and we went risk off in that rally following the outcome of the U.S. election in November. And it was based on a few key things. First, fundamentals are in an okay starting point, but we do see the potential for fundamental erosion to start to become more at the forefront of investor concern, whereas really strong technicals were driving the ship last year and really drove spreads materially tighter to levels that we hadn't seen since before the great financial crisis. Now, that's helpful because you've seen a lot of inflows into credit ETFs and mutual funds, but that also leaves credit a little bit more susceptible to volatility, as some of those investors might get a bit skittish if they see total return losses because of rising yields or equity market volatility, or if any sort of recession or slowing economic narrative starts to come into the conversation.
Winnie, just to sort of underscore what you're saying that there's actually a fundamental deterioration that's been feeding into your bearishness, just even putting aside any kind of rate increase, and that really is the reason why maybe you're shifting away even from the more exposed, the more leveraged companies. Is that correct?
Yes. So it's a twofold thesis here. First, we've already started to see credit fundamentals shift a little bit to a weaker territory. They're still kind of at long-term average levels, especially for higher quality parts of the market. But we've seen interest coverage levels come down quite meaningfully as borrowing costs have ticked up. We've seen decent EBITDA growth across the credit market, but it definitely hasn't been ramping up or accelerating. And then even before the Trump election victory, we had expected that issuers were going to start to focus more on intentional releveraging through M&A, share buybacks, other sort of kind of equity juicing incentives, because they've been in balance sheet kind of defense or preservation mode for so long. And now it's the time to start to look to buy growth. And that generally comes with a little bit more execution risk. And it feels like we're kind of teeing up for this perfect storm of potential challenges within the credit market.
What does the maturity cycle look like, Winnie, given the fact that we're looking right now at all-in yields of almost 7.5% for high-yield companies? You're looking, if it really rises materially, it could be punitive for some of these companies. So how much are we seeing them actually have to incur the borrowing costs that we're seeing?
Yeah, this is a really interesting story. Within the investment grade market, there's always the kind of constant maturities. And in the next couple of years, you see very lumpy maturities, especially for financials issuers. Now, the good news is that spreads are still very tight, especially for financials, and they tend to be a little bit more focused on spreads than all-in yields. But from kind of an all-in borrowing cost perspective outside of financials, things have really been ramping up. And there are definitely a few key sectors that have pretty lumpy near-term maturities, be it autos or leisure. Within the leveraged finance market, it's a little bit of a different story because last year was so strong that we saw a lot of issuers very proactively push out maturities. This is especially true in the broadly syndicated loan market, where the amount of repricing and extension activity was really staggering. It almost kept pace with the U.S. investment grade market in terms of gross issuance overall, and it's a much, much smaller market. So we're not as concerned about kind of the near-term maturity side of things within leveraged finance, but we could see liquidity get a little bit more challenged if some of the growth expectations don't come in as strongly as people are currently forecasting.
Winnie Cisar of CreditSights. Winnie, appreciate your perspective. Less than bullish, that's for sure, on credits compared to a lot of bulls that came on this programme at the end of last year into the new year. One debt market we're hyper-focused on right now. This move for the UK government bond market, yields higher by 11 basis points now. Let's call it 480, and the pound getting absolutely hammered. That's one to watch through the rest of today. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Los Angeles is ramping up evacuation orders as the Palisades fire continues to rip through the area. Parts of northern Santa Monica now are under alert as widespread and damaging gusts worsened the situation. The Palisades fire was almost at 3,000 acres, while 2 other blazes flared up overnight, one near Altadena and the other near Salmar, southeast of Santa Clarita. President-elect Trump has asked the U.S. Supreme Court to step in and stop his hush money sentencing from going forward. The sentencing is due for this Friday, January 10th. The filing follows a verdict from a New York judge who rejected Trump's argument to vacate the 34 felonies in light of his presidential victory. Justice Juan Merchan, who oversaw the trial, has already said that he won't sentence Trump to any time behind bars. Former President Jimmy Carter is lying in state at the Capitol Rotunda. Lawmakers came together yesterday for a ceremony to honor Carter's life and legacy. The former president's state funeral will be held tomorrow, where President Biden will be among those delivering a eulogy. And that's your brief, John.
Danny, thank you. Shocking pictures coming out of Los Angeles. Appreciate the update there. Thanks, Danny. Up next on the programme, we'll set you up for the day ahead. Plus, we'll catch up with David Rubenstein of the Carlyle Group in just a moment. From New York, this is Bloomberg. The opening about 40 minutes away. Equities recovering from losses earlier in the session. We were down by more than 1% at one point on a Russell. The Russell's down by just 0.6. The S&P unchanged. A dovish Governor Lawler. Downside surprise on ADP. No doubt helping things out. Just a touch in the bond market as well, with yields off the highs of the session stateside. Can't say that for what's happening in the UK at all. With less than 1 hour to go until that opening bell, let's get you some morning movers with Manus Cranny. Hey, Manus.
Jonathan, big tech will welcome anything that's dovish, but Apple on the back foot as Indonesia banned the iPhone 16 sales. That's still in place. They want more investment from Apple in the country. $1 billion investment to make your AirTags is not enough. Let's roll it along. D-Wave, Jensen Huang lampoons the idea that you're going to have quantum computing that's useful to you very soon. 17 years. Maybe 20 if you're lucky. Roll it down. Finish it off with Novo Nordisk. It's been through some very, very tortured moments over the past couple of months, Jonathan, on one of their new GLP-1s. Today, UBS come out with a buy rating on the stock. The sell-off is overdone. Positive inflection point for GLP-1s. Yes, they shave back on the price tag, $750 from $1,100. Up 3.67%. Jonathan.
Yes, thank you, sir. Appreciate it. As we count you down to that opening bell, some data points to watch throughout this afternoon, including the number that we get from the Fed a little bit later. The number of people that maybe use the policy uncertainty to change their forecasts down in Washington, D.C. I think that's what I want to know. Isn't that what you want to know?
Well, basically, who among them is taking a look at the potential of tariffs and some of the other spending and saying, all right, just for that, we're not going to cut rates. Forget about it. Maybe we'll get names. We're not going to get names. You think we're going to get any color on that whatsoever?
I'd like a number at least.
Okay.
How many? Couple? Few? Several? Let's try and find out. 2 p.m. Eastern Time. Tune in. Thursday, of course, tomorrow, US equity markets close for a national day of mourning for the former president, Jimmy Carter. On Friday, on the data side of things, it's a big one. We get payrolls, so look out for that on Friday morning. And coming up tonight on Bloomberg TV, just a programming note for you, peer-to-peer conversations with David Rubenstein. David's sitting down with Eli Lilly CEO, David Ricks, so look out for that. I'm pleased to say that David joins us now for more. David Rubenstein, welcome to the programme, sir. We've all caught up with Dave Ricks over the years. He's a fantastic leader. What did he have to say to you this time around?
Well, Dave Ricks is the CEO of Eli Lilly. Eli Lilly is a company that was started in 1876, a very respectable drug company, pharmaceutical company. But in the 5 years that he has been the CEO, the stock is up about 9 times. And that's in part because of the GLP-1 drug that they have, which is called Zepbound. They have also one, Mounjaro, which is for diabetes. But these are the weight loss drugs that we've all been talking about. And it's amazing what's happened in the pharmaceutical industry. The Eli Lilly was always a successful company, but nothing like we've now seen. In fact, it is now likely to be the first pharmaceutical company in the world to have a market capitalization of $1 trillion. It's now about $900 billion or so. And this is because people want to lose weight. Roughly 70% of the people in the United States are overweight, and amazingly, 40% are defined as obese. So this drug does tend to reduce your appetite, and it does have a beneficial impact It now seems that it might also have a beneficial impact on other related problems that people have, addiction, smoking, and so forth. Those studies are underway. But right now, there's no doubt that people want to lose weight and that people are using either the Novo Nordisk product, which is better known as Ozempic, or the product known as Zepbound by Eli Lilly.
How much is the optimism in the likes of Eli Lilly really dependent on the idea of the government actually covering the cost of some of these drugs at a time where that's been one of the hottest contested issues in that space?
Well, the government has gone back and forth on this from time to time, but private insurers are covering it to some extent. Not all of them are. But if you have insurance and it's covered, your costs are roughly $25 a month for each person who uses it. So that's affordable for most people. And many insurers are increasingly covering it because it does beneficial things for insurers. Think about this. If you have people that lose weight, they are going to be having less health problems. They have less health problems. The insurers will have to pay out less to their doctors and so forth. So there's a real benefit to insurers to getting people on this drug because in the end it lowers the cost of insurance.
David, I'm going to be heading down to Washington, D.C. for President Carter's funeral tomorrow. And you actually were a domestic policy advisor under the Carter administration. And before we end, I'd just love to get your thoughts on what you want Carter's legacy to be, maybe what the public didn't see behind the scenes.
I did spend 4 years in the White House as a deputy domestic policy advisor. I worked for Stuart Eisenstadt, who was a domestic policy advisor. It is ironic. Jimmy Carter came to Washington in 1977 and a conquering hero. He'd beaten Nixon, Ford, the regime, and really beat Gerald Ford. He came in with high expectations. People thought this man is going to change Washington, D.C. He tried many things. He had a lot of political problems, and the hostages in Iran were another. And so he left Washington very defeated. He was humiliated in the loss he had to Ronald Reagan. It was a staggering loss. Carter really couldn't quite believe he could lose to Ronald Reagan. Now he comes back 44 years later as a man who is lauded by almost everybody for the things he's done in the 44 years since he left the White House. Among those, winning a Nobel Peace Prize, doing things like election monitoring around the world, helping to eliminate guinea worm and river blindness, doing Habitat for Humanity and so forth. So it's amazing how the turn of events has taken Carter from somebody who was very popular, not so popular, and now extremely popular back in Washington.
David, looking forward to honouring him tomorrow, that's for sure. Appreciate your time today. And, of course, congratulations for being awarded with the Medal of Freedom, the highest civilian honour in this country. Thank you, sir. David Rubenstein there of the Carlyle Group and host of Peer-to-Peer Conversations. Coming up tomorrow, look out for this. We'll be catching up with George Goncalves of MUFG, Nita Richardson of ADP, Jim Zauter of Apollo, and the former Speaker of the House, Kevin McCarthy from New York. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.